Hello there and welcome to History for Lunatics. I'm so glad you're here tonight. Pull up something comfortable. Maybe a blanket, maybe a warm drink, maybe just the quiet corner of the room where the day finally stops asking things from you. Tonight, we are going somewhere that still feels strangely alive. Even though the men who stood there are long gone, the paper they shouted over has yellowed, and the machines that carried their numbers have fallen silent. We're going to Wall Street in October of 1929. Not the Wall Street of clean glass towers and computer screens. Not the Wall Street where trades move faster than a person can blink, but the older Wall Street of marble steps, brass railings, stiff collars, crowded offices, cigar smoke, wet overcoats, polished shoes, ringing telephones, and ticker tape curling out of machines like thin white ribbon. We're going to imagine what it felt like to be a stockbroker during the crash. Not a banker in a private room making grand decisions over lunch. Not a famous financier whose name appears in textbooks. Just a working broker, one of the thousands of men whose job was to stand between ordinary people and the market, to take their orders, answer their calls, calm their nerves, repeat the prices, watch the tape, and pretend, as long as possible, that the system around him still made sense. And here is the thing that makes this story different from the way the crash is usually told. When we talk about 1929, we often talk about numbers. The Dow fell this much, the market lost that much, billions of dollars vanished, fortunes collapsed, banks failed, the Great Depression followed. Those facts matter, and we will get to them carefully. But numbers have a way of making disaster feel clean. They sit on a page, they behave themselves, they do not sweat through their collars, they do not grab the telephone with shaking hands. They do not look across a crowded office and realise that every person in the room is waiting for someone else to say that things are under control. Tonight, we are not starting with the chart. We are starting with the man standing beside it. Imagine him for a moment. He's maybe 34 years old, though the strain of the last week has made him look older. He works for a brokerage firm near the New York Stock Exchange, close enough that he can feel the mood of the street change before the newspapers have time to explain it. He is not poor. He's not rich in the way the newspapers mean rich. He's one of those men who has dressed like confidence for so long that he almost believes he has become it. A dark suit, a clean shirt, a tie tied carefully that morning, a hat he removes when he enters the office, a fountain pen in his pocket, a watch he checks too often. His shoes have been shined because in 1929, appearance still carries authority. If a client is going to trust you with money, you cannot look uncertain, even when you are, especially when you are. He has a desk, but he rarely sits at it for long. Brokers in a busy office are not still men. They move between the telephone, the quotation board, the ticker, the order clerk, the partner's office, the door, the window, and back again. They listen for the click of the machine. They scan names that have become familiar as family members: US Steel, General Electric, Radio Corporation of America, Montgomery Ward, American Telephone and Telegraph. Stocks that only a short time earlier had seemed less like paper claims on companies and more like proof that America had discovered a new law of gravity, one in which prices could rise and rise and rise because the country was modern now, because factories were busy, because radios were in parlours, because cars were on roads, because refrigerators and vacuum cleaners and electric lights had turned the future into something a salesman could demonstrate in a showroom. That was the mood of the late 1920s, or at least the part of it people wanted to remember. The decade had been loud with confidence. The war was over. Cities were taller. Credit was easier. Advertisements spoke in the language of improvement. Buy now, pay later. Own the future before you have fully earned it. To people with enough money to invest, and to many without enough money who borrowed to invest anyway, the stock market did not feel like gambling. It felt like participation in the American rise. Your broker was the man who opened that door. He was not merely a salesman, he was a translator of opportunity. He explained margin accounts, he relayed rumours, he gave advice carefully or carelessly, depending on the office and the man. He knew which clients wanted facts and which clients wanted permission. He knew who was risking spare money and who was risking the house without quite saying so. And this is where I want you to pause with me for a moment, because there is a human detail inside this system that is very easy to miss. A stockbroker in 1929 did not only handle money, he handled hope. He handled a schoolteacher's savings, a doctor's spare cash, a widow's inheritance, a businessman's borrowed stake, a young married couple's idea of a better apartment, a retired man's belief that he had been too cautious for too long. He heard voices on the telephone that were trying to sound casual while asking whether to buy more. He saw men walk into the office pretending they had simply been nearby and thought they would check the latest quote. He watched clients study the board as if the numbers might reward them for staring long enough. By October, he had heard every version of the same sentence. It can't keep going down, can it? That question is simple, but in a brokerage office in 1929 it carried the weight of everything. Before we go further into that room, let me ask you something. What time is it where you are right now? Is it late enough that the streets outside your window have gone quiet? Are you listening from bed, from a couch, from a desk where you meant to do one more thing before sleep and somehow ended up here instead? Wherever you are, I want you to think about the small comfort of knowing that the numbers in your life are probably not changing while you listen. Your rent is not moving by the minute. Your grocery bill is not rising and falling on a strip of paper. Your savings are not being shouted across a floor by men in rolled-up sleeves. For the stockbroker we are following tonight, that kind of stillness is gone. His world is made of updates, prices, calls, orders, cancellations, loans, margins, rumours, reassurances, and under all of it, the quiet fear that the market has become too large, too fast, and too nervous for any man to understand while standing inside it. If this kind of storytelling speaks to you, if you like history told slowly enough that the people inside it have time to become real, it would mean the world to me if you hit that subscribe button and give this video a like. You do not have to do it right now. Do it when you feel it. When something in this story makes you stop for a second and picture a face in a crowd, or a hand on a telephone, or a man walking home after a day that took more from him than he knew how to explain. And if you want to tell me where you're listening from tonight, leave it in the comments. I genuinely love reading those. It is a strange and comforting thing, knowing that a story about a crowded street in 1929 might be heard in a quiet room almost a century later by someone in a city those brokers may never have imagined, at an hour when the whole world feels a little softer around the edges. Now, let's begin properly. The date is not yet Black Tuesday. That matters. Disaster rarely introduces itself by name when it first enters the room. It arrives as uneasiness. It arrives as a delay in the ticker tape. It arrives as one client selling earlier than expected, then another, then a group of them all calling at once. It arrives as a partner closing his office door. It arrives as a messenger boy running instead of walking. It arrives as a newspaper headline that sounds serious but not final. By the time October 1929 became a phrase people would say with a lowered voice, the men living through it were still trying to treat each day as something that might be corrected by the next. Our broker has been watching the market for months. He has seen sharp breaks before. Every man on Wall Street has a memory of a bad day that later turned into nothing. That memory is dangerous because it teaches confidence in the wrong direction. In the late 1920s, buying stocks on margin had become common enough that the practice no longer sounded reckless to many people who used it. A client did not need to pay the full price of a stock. He could put down a portion and borrow the rest, often through arrangements tied to brokers' loans. As long as prices rose, the arrangement felt almost intelligent. A man could control more stock than he could otherwise afford. If the price went up, his profit was magnified. The broker could explain this with a pencil and a few neat figures on a sheet of paper. The problem, of course, was waiting in the part of the explanation people preferred to rush past. If prices fell, the losses were magnified too. If they fell far enough, the broker would call for more money. A margin call. Two words that sound ordinary until they come for you. In our broker's office, those calls have begun to change the atmosphere. Earlier in the year, a margin call might have been treated as an inconvenience. A client could send over more funds, sell another holding, borrow from a bank, or insist the market would recover by next week. But in the final days of October, the calls carry a different tone. The broker has to ask for money from people who may not have it. He has to tell a client that unless additional funds are provided, the firm may have to sell the stock protecting the loan. He has to say this politely. He has to sound firm without sounding frightened. He has to know that the man on the other end of the line may be sitting in a hotel lobby, a factory office, a kitchen, a bank, or another brokerage house, hearing his financial life reduced to a request he cannot meet. This is not yet the scene people remember from photographs. The crowd outside the exchange, the faces tilted upward, the rumours moving faster than facts. This is the private machinery of panic beginning to turn. The public sees the crowd. The broker hears the voices before the crowd forms. Let us step inside the office in the hour before the opening bell. The room is already too warm, though the morning outside may be cool. Men have arrived early because no one wants to be the last to know. Coats hang on hooks. Hats are stacked wherever there is space. Ashtrays are filling. The telephones sit ready, heavy black instruments that will soon become the centre of the room's nervous system. On the walls are boards where prices will be marked and changed. In some offices, boys with chalk update quotations by hand. In others, the printed tape is read and interpreted as quickly as possible. The ticker machine is a small object compared with the power people have given it. It does not look like a monster. It looks practical. It clicks, prints, advances, spits out abbreviations and numbers. Yet by October 1929, men are leaning over that tape as if it can tell them not only what has happened, but what is about to happen to them. The problem is that the tape is not always current when volume becomes overwhelming. On the worst days, the market moves faster than the machine can report. That detail is important, because it means that fear develops in a fog. A broker may be looking at a price that is already old. A client may ask for a quote that no longer exists. An order to sell may be placed at one number and executed in a world that has already fallen below it. Imagine trying to calm someone with information you suspect is late. Imagine using yesterday's weather report in the middle of a storm and hoping no one notices the rain coming through the roof. That is a little of what the ticker delay meant during the crash. It was not only a technical inconvenience, it was an injury to trust. The market depended on prices, and prices depended on being known. When knowledge lagged behind reality, every man in the office had to work in the gap. Our broker glances at the tape and then at the door. Outside, Wall Street is beginning to gather itself. Messengers move quickly along the sidewalks. Clerks hurry between buildings. There is the familiar sound of shoes on stone, automobile engines, streetcars, voices, the uneven rhythm of a financial district preparing for another day that everyone hopes will be survivable. The New York Stock Exchange stands at 11 Wall Street with its columns and its authority. A building designed to suggest order even when order is exactly what people have come there to find. That is one of the quiet ironies of the crash. The architecture of finance looked steady. The rules were printed, the firms had names painted on doors, the men wore suits, the telephones worked, the clocks kept time. From the outside, the machinery appeared intact, but inside the minds of the people depending on it, something had begun to loosen. Confidence is not a number, but the market cannot live without it, and confidence, once damaged, behaves in a way no broker can fully control. It does not leave all at once. It thins. It becomes conditional. It says, I still believe, but only if the next quotation is better. I still believe, but only if the bankers intervene. I still believe, but only if someone important says the break is healthy. I still believe, but I would like to sell half my position just in case. That phrase, just in case, is often where panic learns to walk. In the office, a senior partner comes out and speaks in a low voice to the men nearest him. He may mention that leading bankers are watching the situation. He may remind them that America is fundamentally sound. That phrase will be used often in this period, sometimes sincerely, sometimes desperately, sometimes because no one has a better sentence available. The broker nods. He wants to believe it. He has reasons to believe it. The country did not seem poor last week. The factories did not vanish in the night. The radio still play. The trains still run. People still buy cars. Men still go to lunch. The difficulty is that markets do not wait politely for the full truth of an economy. They move on expectation, leverage, rumour, and fear. A stock can fall before a company fails. A man can be ruined before he understands what changed. A broker can repeat that the country is strong while watching a client's account become too weak to survive the morning. There is a particular kind of helplessness in that, and I want you to sit with it for a moment. The broker is close to the action, but closeness is not control. He can hear the bell, he can see the orders, he can speak to clients, he can run figures, he can send instructions, he can stand within walking distance of the exchange itself and still be unable to stop what is happening. Modern people sometimes imagine that those near the centre of a disaster must understand it better than everyone else. Sometimes they do. Often they simply receive the confusion first. The first calls begin before the market opens. A client asks whether he should sell. Another wants to know whether the rumours are true. A third says his wife is worried, which means he is worried but would rather not say so directly. Someone asks about radio. Someone asks about steel. Someone asks whether the firm can carry his account for a few more days. The broker answers each one in the voice he has trained himself to use. Measured, clear, slightly upbeat. Not foolishly cheerful, because nobody trusts cheerfulness during a break, but steady enough to suggest that the floor beneath them has not yet disappeared. He says they will know more after the opening. He says there has been pressure, yes, but also support. He says good stocks are still good stocks. He says the market has seen difficult days before. While he says these things, he looks toward the ticker, toward the order desk, toward the partner's door. His confidence is no longer coming from conviction. It is coming from duty. This is his role. A broker who sounds panicked is no longer useful. The opening bell approaches. That small fact gathers the entire room around itself. Before the bell, there is still imagination. Maybe the selling will be orderly. Maybe buyers will come in. Maybe the newspapers have made too much of it. Maybe yesterday frightened the weak hands out and today will be firmer. Men can live inside maybe for longer than you might think. Then the market opens, and maybe has to meet the price. We will get there slowly because the first minutes matter. The crash was not experienced as a single clean drop. It was experienced as a series of reports, shocks, pauses, contradictions, and renewed shocks. A stock opens lower than expected. Another fails to find support. A blue-chip name weakens. Sell orders pile up. The ticker begins its work, then falls behind. A client who was calm at 9:45 is frightened by 10:20. A man who planned to sell only if things became serious begins to redefine serious with every quotation. The broker picks up the telephone. He puts it down. He writes an order. He crosses out a number. He asks for confirmation. He waits. Waiting is one of the most difficult parts of a panic, because waiting gives the mind time to calculate losses it cannot yet verify. Outside, more people are gathering near the exchange. Some are investors, some are clerks. Some are simply curious, drawn by the human instinct to stand near trouble when trouble becomes public enough to watch. Photographs from those days show crowds pressed into the street, men in hats clustered shoulder to shoulder, faces turned toward the building and toward each other, as if the answer might appear in the expression of a stranger. Inside, the broker does not have the luxury of standing still in the crowd. His fear has tasks attached to it. That is what makes his position so strange. He is not merely witnessing the crash. He is working inside it. Every falling price creates something for him to do. Every frightened client becomes a conversation. Every conversation becomes a decision. Every decision may be too late by the time it is carried out. He has spent years learning the language of opportunity, and now he must speak the language of loss with the same professional mouth. Let us leave him there for this first stretch, not because his day is ending, but because it is only beginning to become what history will later name. He's standing in a room full of men who still hope the morning can be managed. The telephones are ringing more often now, the tape is moving, the prices are coming in with that slight delay that makes every number feel both official and suspect. Somewhere nearby, a client is walking toward the office with a newspaper folded in his hand. Somewhere else, a wife is asking her husband whether they are still safe. On the exchange floor, orders are beginning to crowd against one another. Outside, Wall Street is no longer simply a street. It is becoming a place where thousands of private anxieties gather and discover that they are not private at all. And our broker, clean shirt already damp beneath the collar, pen ready, voice steady because it has to be, is about to learn what happens when a job built on confidence is forced to continue after confidence has started to fail. To understand him, we have to slow down before the panic fully takes hold. We have to step back from the shouting floor, away from the headlines, away from the famous dates that history likes to put in bold type, and look at the man himself before the market strips him down to fear and duty. He didn't wake up that morning thinking of himself as a figure in a disaster. No one ever does. He woke as a husband, perhaps, or a bachelor in a rented room, or a young father trying to be careful with money even while making his living around people who were not careful at all. He shaved with a safety razor over a small bathroom sink, dressed in a shirt that had been laundered stiff, fixed his tie in the mirror, and reached for the hat that made him look like every other serious man in Lower Manhattan. Maybe it was a bowler, maybe a Homburg, maybe a fedora, depending on his taste and income. But in our mind we can put a bowler on him because it carries the shape of the period so neatly, round, dark, formal and slightly comic to modern eyes. That is one of the difficulties of imagining the past honestly. The clothing can look quaint while the pressure inside it was entirely real. He did not think of his hat as a costume. It was part of being presentable. It told the street that he belonged among men who handled accounts, sent orders, read newspapers standing up, and had opinions about interest rates before breakfast. He may have lived uptown and ridden the subway down, or crossed by ferry from New Jersey, or walked from a rooming house if he was young and still trying to rise. The city around him was already awake when he moved through it. New York in 1929 did not begin gently. Trucks were delivering crates, newsboys were calling headlines, elevated trains rattled over the avenues, men in suits folded themselves into subway cars with the practiced impatience of people who believed the day had a price attached to every minute. The broker was part of that rhythm. He had learned to walk quickly without seeming to hurry. Hurrying suggested panic. Wall Street liked speed, but it disliked panic, at least in appearance. His office might have been upstairs in a narrow building with a brass nameplate at the entrance, or in a larger brokerage house where clients could sit in a customer's room and watch the market move across a board. It would not have looked like the clean, hushed financial offices we imagine today. There would be paper everywhere. Order slips, newspapers, telegrams, account statements, market letters, circulars from firms, memoranda, scraps of calculations, and the constant white ribbon of ticker tape gathering in loops and coils. There would be men with ink on their fingers and cigarette ash near their cuffs. There would be clerks younger than him, some barely out of school, sent running between rooms with instructions they only half understood, but were expected to carry quickly and without asking too many questions. There would be telephones ringing with a sound that no one in the office could fully ignore, because every ring might be a client, and every client might mean commission, trouble, or both. A stockbroker in 1929 had to occupy a difficult middle ground. He was close enough to money to smell it, but not always close enough to possess it. He could speak daily with men who owned factories, hotels, mills and department stores, then go home to a modest apartment and calculate whether his own household expenses were rising too quickly. He handled the confidence of wealthy clients, and the ambitions of small ones. He had to appear informed even when the market moved for reasons no one could honestly explain. He had to be friendly, but not too familiar, respectful, but not weak, optimistic, but not foolish, careful with promises, but persuasive enough that clients did not take their accounts elsewhere. This was a selling profession wrapped in the language of judgment. The broker sold access, attention, interpretation, and above all the belief that someone competent was watching the machinery on behalf of the customer. When the market rose, that belief was easy to sell. Everyone sounds intelligent in a rising market if they speak with enough confidence. A client buys 10 shares, then 20, then 50. The broker congratulates him on his judgment. The client compliments the broker's advice. Both men remember the conversation in a way that flatters them. The customer believes he has recognized opportunity. The broker believes he has guided a man well. The commission is earned. The account grows. The office becomes lively, and lively offices feel successful. During the late 1920s, that liveliness had grown into something thicker, something almost feverish. Men who had never studied a company's balance sheet spoke about stocks at lunch. Housewives followed market stories in newspapers. Barbers, dentists, lawyers, clerks, small-town merchants, and people who had always considered themselves conservative began to feel that caution itself might be a kind of failure. It was not that everyone owned stocks. That is one of those oversimplifications that makes the period sound tidier than it was. Many Americans had no spare money for speculation at all. Farmers in many regions had been struggling long before Wall Street became frightened. Wages and prosperity were uneven. But among those who were close enough to the boom to feel its heat, the market took on the quality of a national conversation. It seemed to say that the future had opened for those bold enough to enter. A broker's job became easier and more dangerous at the same time. Easier because clients wanted to buy. More dangerous because clients wanted to believe the buying could continue without consequence. Our broker knew this. He may not have admitted it in those words, but he knew it in the way a man knows the habits of his work. He knew which clients were sensible and which were carried by excitement. He knew the widow who never wanted risk but had been persuaded to buy a so-called sound issue because the income from bonds felt too small. He knew the young salesman who spoke too loudly in the customer's room after a good week. He knew the factory owner who could afford a loss, and the office clerk who could not but behaved as if the market had personally invited him upward. He knew the man who always said he was only speculating with extra funds, though the broker had seen enough of his account to suspect that extra had become a flexible word. The broker kept these distinctions in his head because they mattered, even when the account statements reduced everyone to balances and positions. Each account had a temperament. Some clients called too often, some did not call enough. Some wanted reassurance more than advice. Some wanted to be talked out of panic, and later resented the man who talked them out of it if prices fell again. That was part of the burden of the work. Advice becomes personal when money is disappearing. A recommendation that felt clever in March could sound almost criminal by October. The same client who had thanked him in summer might accuse him in autumn of not warning him, not protecting him, not knowing, not seeing, not doing the impossible. And underneath all of this was the broker's own exposure. We should not imagine him as merely a neutral servant of other people's fortunes. Many brokers invested for themselves. Some speculated heavily. Some believed their own optimistic market letters because believing them made the work easier. A broker surrounded all day by rising prices could begin to mistake proximity for insight. He heard rumours before others did, or thought he did. He watched orders come through. He saw who was buying. He knew which names were fashionable. He might feel that he was too experienced to be caught like an amateur. That feeling is always dangerous. It dresses itself as knowledge. Our man may have had a few positions of his own, perhaps bought on margin like his clients, though he told himself his judgment was better and his timing would be sharper. It is a very human thing to believe that the trap one explains to others will not close on oneself. His morning routine carried traces of that confidence. He read the financial pages with a pencil nearby. He glanced at reports from the previous session. He noted call money rates, dividend talk, bank statements, rumours about pools operating in certain stocks. Pool operations were one of the period's less innocent features, organised groups that could push a stock upward and create the appearance of excitement, drawing in outsiders before insiders sold into the rise. Not every movement in the market came from such manipulation, but enough did that a careful broker learned to listen for the difference between real demand and staged enthusiasm. The difficulty was that staged enthusiasm could make money too, at least for those who left in time. That phrase appears again and again in the unwritten logic of speculation. In time. Everyone imagines leaving in time. Few people imagine the door will narrow when everyone moves toward it together. By the time our broker reached his office in the days around the crash, he had already been trained by years of rising markets to interpret trouble through habit. A sharp break might be a buying opportunity, heavy selling might shake out weak holders, bankers might support the market, strong men might step in, good stocks might recover. These phrases were not meaningless. Sometimes they had been true. That is what made them powerful. A false reassurance that has never worked before is easy to dismiss. A reassurance that has worked repeatedly becomes part of a man's mental furniture. He sits on it without testing the legs. In the customer's room, the broker could see the human side of that furniture beginning to wobble. Men who once lounged near the quotation board now stood closer to it. Men who once joked now asked shorter questions. The cheerful amateur experts had grown quieter. Some clients still performed confidence for one another, because public fear was embarrassing. A man might lose money and still try not to lose face. He could stare at a falling price and say that he had been meaning to buy more anyway. He could laugh and call it a healthy reaction. He could tell another man that only fools sold good securities in a temporary decline. Then he could step into a side office and whisper to the broker that perhaps half the position should be sold if a decent bid appeared. The broker heard both voices, the public one and the private one. This gave him a view of society that was intimate and not always flattering. He learned how quickly conviction changed when collateral was threatened. He learned that confidence often depends on who is listening. He learned that men who spoke boldly about capitalism in general could become extremely specific when their own money was at risk. But he was not outside that behaviour. He was made of the same material. If anything, his training made him better at disguising it. His face had to remain composed. The man beneath the bowler hat had a private mind and a professional face, and on Wall Street in October 1929, the distance between those two things became harder to maintain with every hour. Think about the physical strain of the job for a moment. This was not the silent work of clicking a mouse in a climate-controlled room. A busy brokerage office was a loud place, and during panic it became a place of physical agitation. Telephones rang until the sound seemed to settle into the nerves. Men raised their voices not because they were rude, but because the room made quiet speech useless. Clerks hurried with paper. Orders had to be written clearly and transmitted correctly. A wrong figure could matter. A delayed message could matter. A misunderstood instruction could become a financial wound. The broker might hold one receiver while another line waited. He might signal to a clerk while listening to a client who was talking too fast. He might ask for a quote and receive one already stale. He might promise to call back and immediately forget because 3 other fires had started at once. His lunch might sit untouched. His cigar might burn itself out in an ashtray. He might not notice how long he'd been standing until the day ended, and his legs suddenly belonged to him again. There was also the moral strain, quieter and heavier. Suppose a client wanted to sell and the broker believed the market might rebound. Should he advise waiting? Suppose a client wanted to buy because prices looked cheap. Should he encourage it? Suppose the firm needed accounts to meet margin requirements. Should he press harder? Suppose he knew a client would be ruined if the decline continued, but also knew that selling into panic could make the ruin immediate. In calm times, these questions could be handled with phrases. In a crash, the phrases lost their protective coating. Every answer felt like a bet on another person's life, and yet the office could not stop to discuss the ethics of each order. The machinery demanded action. Buy, sell, hold, wire funds, meet margin, liquidate, confirm, repeat. The words were short because the day had no patience for long explanations. The broker himself had probably entered this profession with some mixture of ambition and practicality. Wall Street attracted men who liked numbers, but also men who liked status, pace, and the possibility of advancement. It was a place where a clever young man could imagine rising faster than in more traditional work. He did not have to wait for land to yield crops or for a factory to expand. He could attach himself to the flow of capital itself. That sounded modern. That sounded American in the 1920s. The broker's parents, if they were still alive, may not have fully understood what he did. They understood buying and selling perhaps, but not the constant abstraction of securities, loans, options, pools, and paper wealth. His wife, if he had one, understood it through his moods. Good weeks made him generous, bad weeks made him quiet. In the summer, he may have spoken at dinner about a client who made a killing in radio or another fashionable stock. In October, he may have stopped naming figures at home. A household can sense financial fear before it is explained. A man comes in later. He removes his hat more slowly. He does not want much supper. He says the day was difficult, then changes the subject. His wife asks whether everything is all right, and he answers in the way people answer when they are trying to protect both the listener and themselves. Yes, just a rough market. It will settle. That was another sentence widely used in 1929. It will settle. It sounds calm. It gives time a job. It assumes that disorder is temporary and that the future has an obligation to become reasonable again. In ordinary life, this is often true. Children stop crying. Storms pass. A fever breaks. A business problem can be worked through. Markets, too, sometimes settle. But they do not settle simply because exhausted men need them to. Our broker is beginning to learn this, though he has not learned it completely yet. He still believes in the usefulness of composure. He still believes that the right men in the right rooms can steady things. He still believes that panic is partly a failure of nerve and that nerve can be restored if enough respectable people behave as though restoration is expected. These beliefs are not foolish in themselves. Society depends on them more than we admit. Banks, markets, currencies, credit, even ordinary business trust all require people to act as though tomorrow will resemble today closely enough for promises to matter. The crash of 1929 was terrifying not only because prices fell, but because it forced people to ask how much of their prosperity had rested on agreement, assumption, and borrowed time. The broker stood at the exact point where those questions became practical. When the client asked, "Am I safe?" he could not answer philosophically. He had to look at the account. He had to look at the loan. He had to look at the price. He had to say what could be done before the next decline made the answer obsolete. Beneath the bowler hat, beneath the professional voice, beneath the polished shoes and the clean collar, he was a man trying to remain useful while the meanings of his own words were changing. Value was changing. Security was changing. Sound was changing. Temporary was changing. Even wealth was changing, because wealth that had existed so confidently on paper was proving how quickly paper could become a record of loss instead of ownership. Late in the morning, or perhaps early in the afternoon, he would catch sight of himself in a darkened window or the glass of an office door. Not a long look, just a reflection as he moved past. Hat slightly off angle now, tie not as neat, face drawn tighter than it had been when he left home. He might barely recognise the expression. He had seen it on clients many times and privately judged it. Too emotional, too exposed, too late. Now it was on him. That is one of the cruel little reversals inside a panic. The professional observer becomes a participant before he has agreed to it. A broker could spend years watching other men learn fear, and then one morning realise fear had learned his name as well. Still, he kept working. This matters. History often remembers collapse as if everyone simply froze in astonishment. Some did, many did not. Clerks kept carrying orders, telephone operators kept connecting calls, messengers kept running, brokers kept answering. The machinery of the market continued even while confidence inside it was cracking. That is what made the scene so exhausting. There was no clean moment when someone turned off the lights and declared the old world over. The old world continued to function badly, loudly, and with increasing damage. Our broker remained at his post because there were clients to answer and accounts to manage, and partners watching and younger clerks taking their cues from his face. He could not afford the luxury of visible despair. Around him, the office was becoming a study in controlled disorder. A man laughed too loudly near the board. Another snapped at a clerk and apologised without looking up. Someone asked for water. Someone else wanted the latest quotation and then refused to believe it. The tape continued its thin mechanical speech, indifferent to the human weight placed on it. Outside, the crowd on Wall Street thickened, and inside, the man beneath the bowler hat adjusted his cuffs, reached for the telephone again, and prepared to speak in the steady voice of a profession that had been built for confidence, just as the decade that made him was about to show him what confidence could cost. Before it cost him anything, confidence had given him a living. That is the part we have to understand before the crash makes everyone look foolish in hindsight. The brokerage office of the late 1920s was not built out of madness from the beginning. It was built out of habit, ambition, modern convenience, real growth, borrowed money, and the very ordinary human desire not to be left behind while other people seemed to be moving upward. In that office, before the bad days became famous, the morning often began with a sense of activity that could pass for health. Men arrived briskly, removed their hats, opened newspapers, checked overnight news from Europe, read the financial columns, and looked toward the ticker machine as if greeting a colleague whose mood would determine the day. The office had its own weather. Some mornings felt bright before a single order had been placed. A favourable earnings report, a bank statement read the right way, a rumour that a company might raise its dividend, or simply a strong close the day before could lift the room. Clerks moved faster, brokers spoke louder, clients came in smiling, pretending they were only curious, though everyone knew curiosity was rarely innocent in a rising market. A man who said he was just checking prices might remain for an hour. A man who claimed he had no intention of buying might ask 3 questions about a particular stock, and then ask what margin would be required. The office encouraged this gradual surrender. It was designed, whether intentionally or not, to make the market feel close, visible, and manageable. The quotation board gave names and numbers a public body. The ticker gave movement a sound. The customer's room gave ordinary investors a place to sit among others who shared the same appetite. A man could come in uncertain and leave convinced that he had witnessed proof. "Look," he might say, pointing at a name moving higher. "There it goes again." That phrase, "there it goes again," did more work in the 1920s than any formal theory of finance. It turned movement into argument. The stock was rising, therefore someone must know something. Someone knew something, therefore buying made sense. Buying made sense, therefore waiting might be foolish. A broker did not have to push hard when the room itself was already pushing. The job was sometimes as simple as giving excitement respectable language. He might not say gamble, he would say position. He might not say rumour, he would say market talk. He might not say debt, he would say carrying the account. The words mattered because they allowed clients to think of risk as businesslike. That was one of the great services Wall Street provided to the imagination of the 1920s. It made speculation wear a suit. Inside the office, the Roaring Twenties did not roar like a jazz band. They clicked, rang, muttered, scratched, shuffled, and shouted names over desks. The decade outside had its bright surfaces, dance halls, automobiles, radio programs, electric signs, department store windows, baseball scores, movie palaces, and women with shorter hair walking with a confidence that older people often mistook for national decline. But inside a brokerage house, the same decade appeared as paper and sound. Telephones ringing before the market opened, the tap of typewriters, the scrape of chalk on boards, the soft tearing of ticker tape, the slap of newspapers folded against a palm. The low voice of a senior partner saying that an issue looked well supported. The messenger boy arriving with a telegram and trying not to look too interested in its contents. It was modern, but not sleek. It was fast, but not frictionless. A price still had to travel. A person had to read it. Another person had to repeat it. Someone wrote the order, someone carried it, someone executed it or tried to. The market was already powerful, but it still moved through human bodies. This gave the office a kind of nervous intimacy. Everyone could sense when business was good. Everyone could also sense when something was off before anyone said it plainly. A broker learned to read not only the tape, but the room. He noticed when the usual morning jokes were missing. He noticed when a client who loved to boast stopped boasting. He noticed when clerks began looking toward the partners before answering routine questions. During the best years, though, the room trained men to expect recovery from every disturbance. A break in prices became a chance to buy. A hesitation became consolidation. A warning became the opinion of a man who did not understand the new era. That phrase, the new era, had a particular force in the late 1920s. It meant that old limits might no longer apply. It meant that modern industry, mass production, national advertising, consumer credit, and scientific management had changed the structure of American prosperity. It meant that the United States was not merely doing well, but had perhaps discovered a more permanent form of growth. People did not always say it so grandly, of course. In the office they said it in smaller ways. Automobiles are everywhere now. Radio's just getting started. Everyone needs electricity. Chain stores are the future. Aviation will be enormous. The country is expanding. Good companies cannot stay down. These statements contained pieces of truth. That is why they were persuasive. A full story that contains no truth usually dies quickly. A dangerous story often survives because several parts of it are accurate. America in the 1920s really had changed. There were more cars on the roads. Radios had entered homes with startling speed. Corporate profits in many sectors had risen. Mass production had made goods cheaper and more available. Cities were growing. The financial press had more readers. Ordinary people had more ways to feel connected to business than their parents had ever known. The problem was not that all confidence was invented. The problem was that confidence became easier to borrow than to earn. Our broker lived inside that contradiction every day. He could look at a company and see genuine growth. He could also look at the price of that company's stock and wonder whether growth alone could justify the enthusiasm surrounding it. But wondering quietly and acting against the mood of the market were not the same thing. A broker who warned too often during a boom risks sounding timid. Clients did not come to Wall Street to be told that patience and moderation were virtues. They could hear that from a minister, a father-in-law, or a bank officer in a small town. They came because Wall Street was where motion happened. They wanted the broker to translate that motion into opportunity. If he spoke too coldly, another firm might speak warmly. If he advised caution, the client might thank him, and then take his account down the street to a man who believed in the future with fewer reservations. So the office developed its own incentives, and those incentives had a tone: positive, alert, informed, ready. Not reckless in the open, not crude, but always leaning toward activity because activity meant commissions, and commissions kept the office alive. The customer's room was where that tone became visible. Picture it in the middle of a strong market day. A row of chairs, some occupied by men who had no urgent business elsewhere or had convinced themselves this was business enough. A quotation board at the front. A ticker nearby. Newspapers spread across tables. Men leaning on canes. Men smoking. Men with hats pushed back, men comparing one price with another, men asking what the tape said, men reading meaning into every uptick. There might be a retired merchant who had begun investing in railroad stocks years earlier and now found the newer industrial issues both exciting and suspicious. There might be a young salesman who had turned 3 successful trades into the belief that he possessed instinct. There might be a dentist between appointments, a lawyer avoiding paperwork, a small manufacturer with legitimate reasons to care about credit conditions, and a few men whose finances were less stable than their confidence suggested. They watched one another almost as closely as they watched the board. Markets create communities of comparison. It is never only whether you are gaining or losing, it is whether the man beside you seems to be gaining faster or losing less. Envy can enter a brokerage office dressed as research. A client might hear that another fellow bought radio early and made a fine profit, and suddenly a company that had seemed expensive yesterday became a mischance today. The broker saw how this worked. He might even use it gently, not by lying, not necessarily, but by allowing the atmosphere to do what atmosphere does. People want confirmation from other people. If enough men in one room are leaning toward belief, disbelief begins to feel lonely. This is one reason a brokerage office in the 1920s was more than a workplace. It was a theatre of persuasion where clients helped sell the market to each other. The broker moved through that theatre with practised ease. He greeted the regulars by name. He remembered who disliked being called by his first name and who loved it. He knew which men wanted figures and which wanted a story. He knew how to lower his voice to make a rumour seem more valuable, without making it sound irresponsible. He knew that the phrase, "I cannot advise you directly, but," could be more persuasive than direct advice. He knew the importance of timing. Mention a stock too early and the client might ignore it. Mention it after a visible rise and the client might feel foolish for not acting sooner, which could be even more effective. This does not mean every broker was dishonest. Many were conscientious. Many believed sincerely in the investments they recommended. Many tried to protect clients from the worst of their own impulses. But the structure of the business placed sincerity and salesmanship in the same chair, and not every man could keep them separate. By 1929, a broker could spend the morning explaining why a stock was attractive, the afternoon urging another client to provide more margin, and the evening telling himself that these were simply the ordinary demands of finance. The office made the extraordinary feel ordinary through repetition. The first time a small investor bought on margin, it may have felt daring. The 10th time, it felt like method. The first time a client made money faster than his wages could have earned it, the experience was almost intoxicating. After that, ordinary saving could feel slow and even faintly stupid. This is an important point, because the boom did not only change account balances, it changed people's sense of time. A factory worker might understand that wealth came slowly through labour. A shopkeeper understood inventory, rent, and monthly receipts. A farmer understood seasons, weather, debt, and the stubborn pace of crops. The market offered a different clock. A stock could rise in a day. A profit could appear before a man had done anything physical to earn it. The broker's office was one of the places where that new clock was displayed publicly. Men came in to watch time turn into money, and for a while it seemed to do so obediently. The ticker tape encouraged that illusion because it broke the market into constant little events. Each printed price was a fresh occasion for feeling. Up an eighth, down a quarter, up 2 points, heavy trading, new high, sudden weakness, recovery. The machine made finance feel immediate. It also made it hard to look away. A farmer could not dig up his field every hour to see whether the crop was growing, but an investor could check the tape and experience hope or fear several times before lunch. That was not a small psychological change. It turned ownership into a kind of daily weather, and a broker's office into the place where people came to stand under it. The men who worked there adapted to this emotional climate. They learned not to overreact to every move. At least they learned to appear that way. A good broker did not jump at each decline or grin too widely at each rally. He cultivated a face of informed moderation. If a stock rose sharply, he nodded as though the move confirmed something he had expected. If it fell, he frowned thoughtfully rather than fearfully. Clients studied that face. In an uncertain market, a broker's expression could become an unofficial quotation. The job required a kind of acting. But acting does not mean falseness in the simple sense. Much of adult life requires roles performed under pressure. The doctor must sound calm in front of a patient. The teacher must maintain order when tired. The captain must give instructions even when the sea is worse than expected. The broker had his role too. He was the man who watched the market without being swallowed by it. During the Roaring Twenties, that role was rewarded. Clients praised steady nerves. Partners noticed profitable accounts. Younger clerks watched and learned. The office hierarchy reinforced the culture. At the bottom were runners, board boys, stenographers, junior clerks, and office boys who absorbed the language before they fully understood it. They learned ticker symbols the way other boys learned baseball lineups. They saw which brokers drew wealthy clients and which struggled. They saw tips exchanged, jokes made, mistakes punished, and good accounts treated with a deference that taught more than any formal lecture could. Above them were the salesmen and brokers, some salaried, some earning commissions, some hoping to become partners. Above them were the firm's principals, men whose names appeared on the door and whose credit relationships mattered. A brokerage firm depended not only on customers, but on banks, loans, reputation, and trust between houses. In quiet times, this structure could feel solid. In busy times, it could feel impressive. During panic, every layer became a channel through which fear travelled. But in the high years before the break, young men looked at the senior brokers and saw a path. The suits were better, the lunches were longer, the voices were lower. Important clients waited for them. A junior clerk might imagine himself there one day, speaking across the desk with that same controlled ease. This ambition helped power the office from within. It was not only clients who believed Wall Street could lift them. The workers believed it too. The broker we are following may once have been one of those boys. He may have begun by carrying orders or updating a board, learning the rhythm of the place before anyone trusted him with advice. He may remember the first time a senior man let him speak to a minor client, and how carefully he repeated phrases he had heard others use. He may remember his first commission, his first good account, his first market break, his first mistake covered quietly by someone above him, his first mistake not covered at all. By 1929, he has acquired enough experience to sound seasoned, but not enough age to be untouched by ambition. He wants the firm to do well. He wants his clients to respect him. He wants the partners to consider him reliable. He wants to be thought of as a man who understands the market's language. That desire is not evil. In fact, it is ordinary. The danger is that ordinary desires placed inside an overheated system can help keep the system hot. He answers calls, he sends letters, he tells a client that the long-term outlook remains favourable. He does not think of himself as feeding a national fever. He thinks of himself as doing his job. That is how most large historical events are built at ground level, by people doing their jobs inside assumptions they did not create and may not have examined closely enough. The Roaring Twenties inside the broker's office were therefore not one continuous party. They were a workday repeated until repetition became belief. Open the office, read the news, check the tape, greet the clients, quote the prices, send the orders, discuss the rumours, reassure the nervous, encourage the eager, collect the commission, close the books, go home, return tomorrow. Each step made sense by itself. Together, over years, they created a room where rising prices felt normal and caution felt almost impolite. Still, there were small signs for anyone willing to look without wanting. The use of credit had stretched far. Some stocks rose with little connection to earnings. Tips circulated too easily. People who did not understand what they owned were borrowing to own more of it. Market letters could sound less like analysis and more like weather reports from a country where it never rained. Even the broker, on honest days, may have felt a slight tightening in his stomach when a client of the modest means wanted to increase a position that was already large for him. He may have suggested restraint once or twice. He may have been ignored. He may have allowed himself to be persuaded by the same argument the client used. The stock had always come back. That phrase, always come back, is one of the most expensive phrases in financial history. It carries no date, no guarantee, no mechanism, only memory. In the summer of 1929, memory was still on the side of optimism. By autumn, memory was beginning to lose its authority. But before the authority broke, the office continued to look like itself. This is one of the unsettling truths of the period. The great turning points of history do not always announce themselves by changing the furniture. The same desks were there. The same tape machine clicked. The same customers entered. The same brokers nodded, advised, smiled, calculated, and reached for the telephone. A man could stand in the middle of the room on a busy September day and see success everywhere if he wanted to. Orders moving, clients engaged, newspapers full of market news. The nation discussing stocks with the familiarity once reserved for crops, weather, and politics. He could also, if he looked differently, see dependence. Dependence on credit. Dependence on mood. Dependence on the ability of more buyers to arrive tomorrow. Dependence on the belief that a quoted price represented something sturdier than the willingness of frightened people not to sell all at once. That second way of looking was harder, and not only because it was unpleasant. It could cost money. It could make a broker sound old before his time. It could make him less useful in an office where usefulness was measured partly by business produced. So he did what many people do in systems that reward optimism. He noticed the risks, filed them somewhere in the back of his mind, and continued with the work in front of him. A client had arrived. A line was blinking. A stock was moving. The tape needed reading. The room needed him. As afternoon light came through the office windows and the paper scraps gathered near the machine, the broker might feel tired in a way that still pleased him. It was the tiredness of a man at the centre of activity. The country was moving, and he was close to the movement. Money came through his hands even when it did not stay there. Important names crossed his desk. Strangers trusted his voice. Young clerks watched him. Clients shook his hand. The office after the close had its own smell of smoke, paper, wool, sweat, and cooling machinery. Men compared the day's business. Someone laughed about a client who panicked too early and missed the rally. Someone else mentioned that prices were getting high, and the room gave the comment a few seconds of respect before moving on. There were accounts to review, confirmations to send, calls to return, and tomorrow's possibilities already forming before today had fully ended. Outside, Wall Street emptied in stages. Men put on hats and became part of the evening crowd. Our broker stepped back into the city carrying the language of the market with him, carrying names and prices the way another man might carry sawdust on his clothes after a day in a mill. At home, at dinner, at a club, in a hotel lobby, on a train platform, the talk followed him because the market had escaped the office and entered ordinary conversation. That was the real sign of the era. Stocks were no longer only what happened at the exchange. They were dinner talk, elevator talk, newspaper talk, barbershop talk, husband and wife talk, dream talk. The broker lived where all that talk became action. He stood at the counter where hope placed its order, and as the decade moved toward its hard October reckoning, the same office that had made prosperity feel organized would become the place where clients learned that a dream bought with borrowed money could turn into a debt by morning. A dream bought with borrowed money does not feel dangerous at first. That is one of the reasons it works so well. It does not arrive looking like a trap. It arrives looking like a shortcut. And in a decade trained to respect speed, a shortcut can seem almost responsible. In the brokerage office, margin was not spoken of with the uneasiness it deserved. It It was part of the ordinary vocabulary of the place, tucked into conversations as naturally as the weather, the morning paper, or the condition of the tape. A client did not always say, "I want to borrow money so I can buy more stock than I can afford." He said, "What would it take to carry another 100 shares?" Or, "How much margin would be required?" Or, "Could the account stand a little more?" Those phrases softened the act. They made debt sound like technique. They made risk sound like structure. They allowed men to walk into the office feeling not reckless but informed. Our broker had explained the arrangement so many times that the words could leave his mouth almost by themselves. Suppose a man wanted to buy shares worth $10,000. He might not need $10,000 in cash. Depending on the stock, the firm, the market conditions, and the rules applied by the broker or the lender behind him, he might put up only a portion of the amount and borrow the rest. If the stock rose, the client's gain was calculated on the whole position, not merely on the cash he had contributed. That was the part people heard most clearly. A small stake could control a larger one. A modest man could stand, at least on paper, beside men with deeper pockets. If he was right, he advanced faster. If he was wrong, he fell faster too, but in a rising market the second half of the explanation often received less attention than it should have. The broker did not have to hide it. It was printed in the agreement. It was discussed at the desk. It was understood in theory. The danger was not secrecy. The danger was that theory had not yet become pain. There is a great difference between knowing a stove is hot because someone tells you, and knowing because your hand has touched it. By 1929, millions of conversations about margin had taken place in the first sense. Men knew, as a matter of arithmetic, that borrowed money could intensify loss. They did not always know it in the body. They did not know how it felt when the telephone rang and the broker's voice was lower than usual. They did not know how it felt to be told that good stocks had fallen enough to make more cash necessary immediately. They did not know how quickly a statement that looked impressive in September could become a demand in October. This is where the stockbroker became more than a salesman. He became the messenger of the loan. When prices rose, he was the man who confirmed success. When prices fell, he was the man who asked for money. That change could happen in the same relationship, sometimes with startling speed. The client who had welcomed his calls during the boom might dread them during the break. A telephone that once delivered opportunity began to sound like a knock at the door from a creditor. Think about that small object on the broker's desk, the telephone. In our world, it is almost invisible, always with us, always offering distraction. In 1929, it was a heavier, more formal instrument, and in a brokerage office it carried urgency. When a margin call had to be made, the broker did not send a gentle philosophical warning. He contacted the client because the account required action. Additional funds had to be provided or securities might be sold to protect the loan. The phrase could be stated politely, but no politeness could change the meaning. Bring money or lose control of what you own. And even that wording is generous, because if the decline was fast enough, control might already be slipping before the client fully understood the situation. Our broker had seen clients respond in every possible way. Some were calm and businesslike, at least on the surface. They asked how much was needed, said they would arrange it, and hung up. Some argued with the quotation itself as if disbelief could revise the tape. That cannot be right. Check it again. I bought it higher than that last week. Others became wounded, almost personally offended by the market, as if the stock had betrayed them. A few grew angry at the broker. Why did you let me buy more? Why didn't you tell me this could happen? Why didn't you sell yesterday? Why didn't you know? Underneath each accusation was the same terrible discovery. The dream had included a lender. The client had imagined profits as his own, but losses had paperwork attached to them. Margin made the boom democratic in appearance, because it allowed people with limited cash to take positions that looked larger than their lives. But it also made the bus mechanical. Falling prices did not merely disappoint investors. They triggered requirements, they created forced selling, they turned fear into procedure. A client might wish to wait for recovery, but the account could demand action before recovery had time to arrive. That is one of the cruelties of leverage. It can make patience unaffordable. The broker understood this mathematically, and by October he was beginning to understand it emotionally. In ordinary conversation, people speak of losing money as if it happens in one clean motion. You had a certain amount, then you had less. In a margin account, loss has stages. First there is worry, then calculation, then notice, then decision, then liquidation if the decision cannot be met. Each stage has its own humiliation. The client first realizes the decline is serious. Then he must learn how serious. Then he must admit whether he can meet the call. Then he must decide what to sell if he has anything else to sell. If he cannot, the firm may sell for him. A man who boasted of owning great American companies in August might discover in October that ownership is a conditional word when financed by borrowed money. He did not own them in the sturdy way he owned a chair or a coat or a piece of land free of debt. He owned a claim that could be reduced, closed, or taken from his control by the movement of prices. The broker had to translate this without sounding cruel. He would pull the account card, look at the debit balance, the securities held, the latest quotations, the required margin, and the deficiency. The figures might be neat. Human distress is often delivered through neat figures. He would ask a clerk to confirm a price. He would calculate again because no man wanted to make this call on a mistake. Then he would reach for the telephone. In those moments, the office noise changed for him. The general ringing and talking faded behind the specific voice of the client. A woman might answer and call for her husband. A secretary might say Mr. So-and-so was in a meeting. A hotel clerk might try to locate a guest. A man might come on the line breathless, already knowing from the broker's tone that the conversation would not be pleasant. Some clients could meet the call, many could not. Some promised funds they did not have yet. Some asked for time. Time was the one thing everyone wanted and the market sold at a very high price. The broker might say he would do what he could. He might mean it. But a brokerage firm was not a charity, and behind the firm were its own lenders, its own obligations, its own fear of being left exposed while prices fell. This chain of borrowing is important. The client borrowed through the broker. The broker's firm often depended on loans from banks or other sources to carry those customer accounts. Banks lent money into the market because it had seemed profitable and secure while prices rose. Call loans could be demanded back quickly. The whole arrangement rested on the assumption that securities could be sold for enough to protect the money advanced against them. When prices moved downward too sharply, that assumption came under pressure from every direction. It is tempting to imagine margin as a private arrangement between one greedy man and one helpful broker, but by 1929 it had become part of a larger credit system. Borrowed money supported stock purchases, stock values supported confidence, confidence supported more borrowing, and more borrowing supported more purchases. The loop looked strong while moving upward. On the way down, it became a machine for transmitting fear. Our broker stood at one of the handles of that machine. He had not built the entire thing, but he helped operate it every day. Here is something worth noticing about the emotional appeal of margin. It did not simply promise profit, it promised belonging. A man with a small amount of cash could enter conversations that otherwise belonged to wealthier men. He could speak of his holdings. He could receive statements from a brokerage house. He could watch the tape and feel personally involved in the progress of companies whose factories he had never seen. Margin turned spectators into participants. For many middle-class investors, that feeling mattered almost as much as the potential gain. The United States in the 1920s was full of objects that made people feel modern. The automobile in the driveway, the radio in the parlour, the installment plan at the furniture store, the electric appliance demonstrated by a salesman who promised relief from older labour. The margin account belonged to the same mental world. It said, you do not have to wait until the full price is in your hand. You can have the thing now. You can join now. You can benefit now. Later will take care of itself. For a while, later seemed cooperative. A man bought on margin and the stock rose. He bought more and rose again. His paper profit confirmed his judgment, though much of the lift may have come from the same broad enthusiasm raising nearly everything around him. He told his brother, he told a neighbour, he told a colleague at lunch. The story travelled in the simple language that always travels best. I put down this much and made that much. The details of maintenance requirements, call money, volatility, and forced liquidation did not travel as easily. They were less exciting. Nobody brags about the trapdoor under the dance floor while the music is good. The broker saw the bragging arrive in account form. New clients came in because someone they knew had done well. Existing clients wanted larger positions because their earlier caution had begun to feel like timidity. A man who had once been satisfied with 20 shares now wanted 100. A man who had one account began opening another for his wife, or discussing one for a son. Some clients asked whether they were too late. This question revealed the fear at the centre of the boom. Not fear of losing, fear of missing. A surprising amount of financial courage is really social anxiety in a clean collar. The client did not want to be the only man at the table who had failed to profit from the new prosperity. He did not want to read that stocks were making fortunes while his savings sat quietly in a bank. He did not want to be prudent if prudence meant watching less prudent men buy larger houses. Margin gave that anxiety a practical solution. It allowed him to close the gap between what he had and what he wished to control. When enough people act on that desire at once, the desire begins to look like national confidence. In the broker's office, this confidence had a daily ritual. The client arrived, the account was discussed, the stock was selected or recommended, the amount of cash was considered, the margin calculated, the order placed, and then came the waiting. Waiting in a rising market is different from waiting in a falling one. In a rising market, waiting feels like proof gathering in your favour. Every uptick seems to validate the decision. The client may grow more relaxed, then more pleased, then slightly greedy. The broker may receive a call asking whether to take profits, and if he advises holding, he may be thanked later when the price rises again. A relationship forms around success. The broker becomes not merely a service provider, but a witness to the client's improved self-image. The client believes he has become the kind of man who understands finance. That belief is delicate. Once formed, people defend it. They do not want to return to being ordinary savers after briefly feeling like market men. Margin helps sustain that identity because it keeps the account large enough to feel significant. But the account does not know or care about identity. It responds to prices. When prices fall, the same leverage that made the client feel substantial makes him vulnerable. Our broker knew the arithmetic with painful clarity. A decline that might have been tolerable for a fully paid investment could become dangerous for a margined one. A 10% fall in a stock did not mean the same thing to every owner. To the man who owned it outright, it was a loss on paper unless he sold. To the man who had borrowed heavily to buy it, it could be the beginning of a forced conversation. This difference was invisible during casual talk. Two men could say they owned the same stock, but one was standing on solid ground, and the other on a plank extended over a deep drop. The market did not need to fall far to make the second man aware of the drop. In October, the broker began to hear that awareness in the pauses before clients spoke. They would ask for a price, then say nothing for a few seconds. Those seconds were full of arithmetic. They were subtracting, remembering, denying, hoping. The broker could almost hear them doing it. He had done the same with his own account. That is another part of the story we should not lose. He may have been making margin calls while fearing one himself. He may have been urging clients to strengthen their accounts while wondering whether he should strengthen his own. A man inside the profession was not protected from the culture that surrounded it. In some ways, he was more exposed. He had seen fortunes made. He had seen dull men rewarded for boldness. He had heard warnings dismissed and then punished by another rally. He had watched caution humiliated for years. That kind of experience teaches lessons, but not always the right ones. It can teach a man that danger is usually temporary. that the crowd is often right enough for long enough, and that stepping aside too early is its own form of loss. By the time the crash began, many people did not need to be talked into risk. They needed to be talked out of the habits success had trained into them. The broker's office had become a school of those habits. It taught people to check prices often, to think in gains, to compare themselves with others, to treat debt as a tool, to treat rising prices as evidence, and to treat warnings as the background noise of men who had missed the move. None of these habits felt insane while they were being rewarded. That is why historical judgment should be careful. It is easy to stand after the collapse and identify every foolish act. It is harder to remember that before the collapse, many of those acts had been applauded by experience. A client who bought on margin in 1927 might have done well. In 1928, perhaps better. Early in 1929, better still. Each success made the next risk feel less like risk and more like a proven method. The broker, watching this, learned how prosperity can become evidence against restraint. By autumn, the office held layers of confidence accumulated over years. The walls themselves seemed to remember good days. Clients had made money there. Men had walked out smiling. Telegrams had confirmed profitable sales. Partners had praised strong production. Clerks had seen commissions tallied and careers advanced. The atmosphere had a memory, and memory resisted the first signs of change. When stocks began to break, many people interpreted the decline through the old pattern. Weakness, then recovery. Pressure, then support. A shakeout, then higher prices. Margin made this interpretation comforting but dangerous. If the decline was temporary, holding made sense. If it was not temporary, holding could be ruinous. The difficulty was that no bell rang to announce which kind of decline had arrived. The only bell that rang was the one that opened the exchange, and after that men had to make decisions with incomplete information and complete consequences. Our broker could look back, even before the crash had fully unfolded, and see how margin had changed the character of his clients. It had made cautious men restless. It had made modest men feel large. It had made successful men impatient. It had made ordinary setbacks dangerous. It had also made the broker himself more necessary and more resented. As long as accounts rose, he was the helpful guide. When accounts weakened, he became the voice of the mechanism. He did not enjoy calling a man to ask for funds. Very few decent men would. But he made the calls because that was the work, and because delay could injure the firm, and because a market falling quickly left a little room for gentleness. Picture him at his desk now with an account card in front of him. The numbers show a position carried too thinly. The stock has fallen again. The client has already been warned once. The broker asks for the latest quote. The quote comes back worse than expected. He calculates, checks, and looks toward a senior man who gives a small nod. That nod is not dramatic. No one in the office stops to watch. But for the client whose name appears on that card, it is the beginning of a very hard conversation. The broker lifts the receiver. Somewhere uptown or across the river or in another city connected by wire, a telephone begins to ring. A wife may hear it from the hallway. A secretary may reach for it on a desk. A man may look up from his breakfast, already annoyed by this interruption, not yet aware that the sound is carrying the market into the room with him. The broker waits through the clicks and faint distance of the line. When the voice answers, he says the name of the firm, then the client's name, then his own. He speaks courteously. He has done this before. He explains that the account requires additional margin. He gives the amount. He says when it is needed. He hears the silence afterward. That silence is not empty. It contains every assumption the client made when he first borrowed to buy the dream. It contains the rising market that seemed so friendly. It contains the conversations in which risk sounded like intelligence. It contains the pride of having joined the people who knew how money worked. Then the client begins to speak, and the broker has to listen, because beneath the polished language of Wall Street, beneath the account forms and the loan arrangements, and the respectable office furniture, buying on margin has finally become what it always was in the background, a promise that could be called at the worst possible moment. The call did not feel different from all the others at first. That is one of the unsettling things about a day that later receives a name. In the moment, it begins as another morning, another price, another client, another correction that might still be contained if enough people remain calm long enough for the machinery to catch up. Thursday, October 24th, 1929, did not walk into Wall Street wearing a black label. It arrived with men buttoning coats against the morning air, with clerks hurrying past the stone fronts of banks and brokerage houses, with newspapers tucked under arms, with shoes striking pavement in the ordinary rhythm of lower Manhattan, and with thousands of people telling themselves some version of the same thing. The market had been weak, yes. It had been ugly, yes. The selling had been heavy. The talk had become serious. But serious was not the same as catastrophic. Serious could still be corrected. Serious could still be explained by professionals. Serious could still become, if handled properly, a sharp break that frightened the amateurs and then rewarded the brave. That was the thought many men carried with them that morning, and our broker needed it. He needed it the way a tired man needs the banister on a staircase. Not because it made the climb easy, but because without it he might feel the drop beside him. He reached the office early, and he was not the only one. The place had the strange alertness of a room where everyone has slept poorly but is determined not to admit it. Coats came off quickly, hats were placed wherever there was space. Newspapers opened and snapped flat. Men searched the columns for language that could help them understand what the previous days had meant. In a brokerage office, the newspaper did not simply report the world. It provided phrases men could borrow until their own thoughts became steady again. A sound market. A technical reaction. Good stocks. Underlying strength. Temporary liquidation. These phrases had travelled through the financial press and the offices and the clubs and the dining rooms for days. They were not useless. Words can steady people. A man who has a phrase for his fear can sometimes hold it at arm's length. But on Black Thursday, the phrases would be asked to carry more weight than they were built to hold. Before the opening, the telephones were already active. Clients wanted to know whether there would be support. They wanted to know whether yesterday's weakness had exhausted the selling. They wanted to know whether to meet margin calls immediately or wait for a better level. Some wanted to sell at the opening and get out before things grew worse. Some wanted to buy because they had been taught that sharp breaks were opportunities. Some simply wanted to hear the broker say that the firm was not worried. That last request was never spoken directly, but it was present beneath many conversations. They did not ask, "Are you frightened?" They asked, "How does it look down there?" The broker knew what they meant. He stood with one hand near the telephone and the other resting on the edge of a desk, as though touching furniture could make the room more solid. He said they would have to see how the market opened. He said there had been selling pressure, but much of it might be forced liquidation. He said leading interests were aware of the situation. He said good securities should not be confused with weak speculation. He said a number of things that were not lies, but not enough either. The problem was that a broker's calm voice could not create buyers by itself. It could not make a client's margin stronger. It could not make a crowded market orderly. It could not make the ticker tape faster. And the ticker, that small machine with its thin printed tongue, would become one of the day's cruel instruments. The market opened under pressure, and almost immediately the office felt the difference between a bad day and a day losing its shape. Sell orders did not arrive singly. They came in waves. A stock would be quoted lower, then lower again, then perhaps not quoted clearly at all because the tape was lagging behind the actual transactions on the exchange. The broker asked for a price and received one that might already be old. A client called to sell and wanted to know what he would get, and the broker could not promise a figure with the certainty the client wanted. This is the part that modern listeners need to picture carefully. In a world without electronic screens, there was no single glowing display where everyone could instantly see the current market. The ticker was fast by the standards of its invention, but it was not magic. It printed transactions after they occurred, and when volume became overwhelming, it fell behind. On a normal day, a delay might be inconvenient. On Black Thursday, it became almost unbearable. Men were making decisions in a fog made of paper. The tape said one thing, rumour said another. The floor might already be somewhere worse. A broker might tell a client the latest reported price while knowing that the word latest had become unreliable. That uncertainty fed panic because fear grows in the space between knowing and not knowing. If a stock is down 5 points, a man can react to 5 points. If the tape says 5 points but someone across the room says 10, and another man says there is no bid at all, then imagination begins doing the work that information cannot do quickly enough. The phones responded to that imagination. They rang and rang until the sound no longer seemed like separate calls, but one continuous demand from the outside world. A client wanted to cancel a buy order placed the day before. Another wanted to sell at market, meaning sell for whatever price could be obtained, a phrase that sounded simple until the market itself became disorderly. Another insisted on speaking only to the broker personally, not to a clerk, not to a partner, not to anyone else. The broker could not be on every line at once. He had to choose, and every choice felt like neglect of someone else. He picked up one receiver and watched another clerk signal that a different client was waiting. He covered the mouthpiece and asked for a quotation. He uncovered it and repeated the figure. The client shouted that the price could not be right. The broker said he would check again. He checked. It was worse. He returned to the line and felt the small, terrible pause before saying the new number. Outside the office, crowds were beginning to collect around the exchange and the brokerage houses. Some people came because they had money in the market and no better way to learn what was happening. Others came because panic attracts witnesses. Human beings have always gathered near fire, accidents, trials, executions, parades, and disasters, not always out of cruelty. Often because when something large is happening, standing near it gives the mind a temporary occupation. The crowd on Wall Street that day was not one kind of person. It was investors, clerks, office workers, messenger boys, curious passers-by, men who had stepped out to hear rumour straight from the street, and people who simply knew that something important was happening and wanted to be close enough to say they had seen it. From the windows above, the street must have looked like a pressure gauge. More bodies, more hats, more faces turned toward doors and windows, more men asking one another questions no one could answer. Inside, the broker did not have time to stare. The phones would not allow it. A margin department clerk appeared with a stack of accounts requiring attention. Forced selling was no longer a theoretical risk from the explanation given weeks earlier. It was here, on paper, with names attached. A client who had been prosperous enough on Tuesday might be deficient by Thursday morning. A position that would have been manageable with a modest decline became dangerous when selling became heavy across the board. The broker looked at the accounts and felt a grim narrowing of choices. Call the client. Ask for funds. Sell if necessary. Call another. Ask for funds. Sell if necessary. The words repeated, but repetition did not make them easier. Each account contained a person who had believed in something. Maybe believed too much. Maybe borrowed too much. Maybe listened too eagerly, but believed all the same. And now belief was being translated into deficits. In one room of the office, a client lost his temper. Perhaps he'd come in personally because the telephone was not enough. Perhaps he had been sitting there since the opening, watching the board change faster than his face could recover from each mark. He demanded that his broker explain why a sound stock was being sold down with the rest. He said the company was good. He said its factories were real, its earnings real, its dividend real. He was not entirely wrong. This is what made the crash so confusing for many people. Stocks could fall for reasons that had less to do with the immediate condition of the business than with the urgent need of owners to raise cash, meet margin, reduce exposure, or escape fear. A good company did not protect a margined investor from a bad market. That distinction, obvious in theory, felt almost insulting in practice. The client had bought quality. He'd been told quality mattered. Now quality was being marked down with everything else. The broker tried to explain forced liquidation, market pressure, lack of bids, the need for patience, the difficulty of the tape. The client heard only that the money was going. In another office nearby, partners and senior men watched developments with a different fear. They were not only concerned for individual accounts, they were concerned for the market structure and for their firm's exposure. Heavy selling could damage customers, yes, but it could also strain brokerages carrying those customers. If clients could not meet margin calls, if stock sold too fast and too low, if loans were called or credit tightened, the danger moved upward through the system. Panic is democratic in its first appearance, but not equal in its consequences. A small speculator could be ruined in one account. A brokerage house could be endangered by hundreds. Our broker may not have known the full condition of his firm, but he would have sensed the tension among the senior men. Doors closed, voices lowered. Telephone calls came from banks, from other firms, from important clients who did not wait on lines like everyone else. The room had several layers of panic operating at once. Public panic from clients, operational panic from orders, credit panic from margin, and private institutional panic from men responsible for keeping the firm alive. Around midday, the story began to widen beyond individual offices. Leading bankers were meeting. That was the kind of sentence Wall Street wanted to hear because it suggested adults had entered the room. A meeting at the House of Morgan carried almost theatrical power in the financial imagination. Men remembered earlier moments when bankers had acted to steady markets, most famously in 1907 when J.P. Morgan himself had become a symbol of private rescue. By 1929, the old Morgan was gone, but the name still had weight. The idea that major bankers were conferring gave brokers something to tell frightened clients. They could say that the situation was being addressed. They could say important interests understood the need for support. They could say the market was not being left to collapse without resistance. In the office, this news moved quickly, not with celebration, but with hunger. Men needed it. The broker used it almost immediately. Yes, there is word that leading bankers are meeting. Yes, support may come in. No, I would not advise panic selling at this moment. Let us see what develops. These were reasonable sentences, and for a while reason seemed to have found an ally. Then came the symbolic act that would become part of the day's memory. Richard Whitney, acting for the banking interests, appeared on the floor of the exchange and placed large bids in leading stocks, including US steel, at prices above the market. It was not only a transaction, it was theatre, and theatre mattered. The purpose was to show confidence publicly in the one place where panic had become most visible. If important money was willing to buy, perhaps others would stop selling. If a respected figure stood in the middle of the storm and acted as though value still existed, perhaps value would become easier to believe in again. When word of the buying reached brokerage offices, the effect was immediate enough to be felt. Not calm exactly, more like a hand pressed against a door that had been blowing open. The broker heard the tone change. A clerk shouted that steel had been supported. Someone repeated the news to the customer's room. A man who had looked pale an hour earlier straightened a little. Another asked whether this meant the worst had passed. The broker did not know, but for the first time that day he could answer with something other than strained endurance. It may help steady things, he said. The market has powerful support now. The sentence travelled through the phone lines like a small ration of warmth. Clients wanted to believe it. Many did. And to be fair, the intervention did help that day. Prices recovered from their worst levels. The market did not close in the full collapse that had seemed possible during the morning. The office, after hours of strain, exhaled in stages, not with laughter, not with triumph, but with the exhausted relief of men who had watched a wall crack and then, for the moment, remained standing. The phone slowed. They did not stop completely, but they loosened their grip on the room. Clerks gathered paper. Brokers compared what had happened in different accounts. Senior men spoke with deliberate optimism. The newspapers would have something to write besides pure disaster. The bankers had acted. The market had rallied from the lows. The machinery had been tested and had not entirely failed. In the customers' room, some men allowed themselves to feel wise for having held. Others felt ashamed for having sold near the bottom. A few were already tempted to buy again, because panic followed by support can create a dangerous kind of courage. It says, you see, the powerful men will not let it fall. It says the system has guardians. It says fear was excessive. It says the brave may still be rewarded. Our broker wanted that to be true, not only for his clients, though he did want it for them. He wanted it for himself, for the office, for the firm, for the city, for the idea that professional calm had meaning. By the close of trading on Black Thursday, he was exhausted in a way that sleep would not fully repair. His ears still held the sound of ringing phones. His hand ached from writing orders. His throat felt worn from repeating prices, explanations, apologies and reassurances. He had seen grown men plead for time. He had seen others rage at facts. He had watched the tape fall behind reality, and then watched reality become rumour because no one could see clearly enough. He had witnessed the street outside turn into a public waiting room for fear, and then, near the end, he had witnessed a rescue, or something that looked enough like one to keep the room from breaking completely. That appearance mattered. It would carry many people through the evening. When he finally stepped outside, Wall Street did not look the way it had in the morning. The crowd had changed shape. Some people drifted away, carrying stories they would repeat at dinner tables, in hotel lobbies, on trains, in clubs, in kitchens, wherever worry had gathered to wait for news. The air was full of talk. A man said the bankers had saved the market. Another said the selling had been overdone. Another said the whole thing was a warning, and he was finished with stocks forever. A broker walking home could hear all three opinions before reaching the corner. He put on his hat and moved through the evening with the heavy politeness of a man who has been useful for too many hours. Perhaps he stopped for a drink. Many did. Perhaps he went straight home because he could not bear another room full of voices. At home, if there was a wife waiting, she would look at his face before asking anything. He might say it was a very bad morning but improved later. He might say the bankers stepped in. He might say the situation was serious but under control. That phrase, under control, was what everyone wanted to believe on Thursday night. It allowed families to eat supper. It allowed clients to sleep, or at least to lie still in the dark and call it sleep. It allowed brokers to fold newspapers and tell themselves that a historic panic had come close, been met, and perhaps been beaten back. Yet inside that relief there was a detail many did not want to examine. If the market had required such dramatic support to survive Thursday, what did that say about its strength? If confidence could only be restored by a public gesture from the most powerful bankers in New York, was confidence truly restored, or merely borrowed for another day? The broker did not ask those questions too loudly, even to himself. He was too tired, and the room at home was quiet, and the human mind has a merciful habit of postponing thoughts it cannot survive all at once. So he removed his collar, washed his face, and let the day settle behind him as best it could. Tomorrow would bring more calls, more prices, more explanations, but Thursday had ended without the final disaster. That was enough to hold for the moment. Across the city, lamps were going out one by one, and in brokerage offices near Wall Street the ticker machines rested after printing a volume of trading that had overwhelmed them. The paper lay in coils and strips, carrying numbers that had arrived too late for many of the men who needed them. The phones were quiet now, but not because the fear was gone. They were quiet because the offices were closed, and because the next round of fear was waiting for morning, when the market would open again, and everyone would learn whether the rescue had been a turning point or only a pause. Friday morning came with the strange relief that follows a disaster which has not quite finished becoming one. The broker woke too early, not because he was rested, but because his mind had continued working after his body stopped. He He may have slept, but not deeply. Men who spend a day answering frightened voices do not easily leave those voices at the office. They follow into the hallway, into the dinner conversation, into the small hours of the night when the house is quiet and the mind begins replaying every decision it made under pressure. He would remember the client who sold too soon, the one who waited too long, the one who promised to send funds by messenger, the one who shouted, the one who went silent, the one who said almost politely that this money had been meant for his daughter's education. The broker shaved in the morning with those voices still somewhere behind his eyes. The city outside was doing what cities do after alarm. It was resuming its shape. Streetcars ran. Men bought newspapers. Breakfast counters served coffee. Elevators carried clerks upward. Wall Street did not become empty because the previous day had frightened everyone. It became fuller, if anything, because fear had given people business there. Clients who had not visited in months wanted to be near their accounts. Men who claimed to have held their nerve wanted witnesses. Others wanted to hear, in person, what could not be trusted over a telephone. The morning papers gave them something to hold. They reported the dramatic selling, yes, but also the banker's intervention, the late recovery, the sense that powerful hands had appeared when needed. That was the part people wanted to underline. The system had bent but not broken. The market had been tested, and important men had stood beneath it. In the broker's office, that idea arrived before some of the employees did. It was already in the air, on the lips of early clients, in the cautious brightness of partners who understood the need to set a tone. A brokerage house after a panic could not behave like a funeral parlour. If clients walked in and saw despair, despair would become policy. So the office performed steadiness. Men straightened their desks. Clerks organised the paper left from Thursday's storm. The ticker was prepared again. The quotation board waited. The telephones sat in rows like animals that had finally stopped barking, but might begin again at any sound. The broker entered that room and felt both grateful and suspicious. Grateful because the place still functioned. Suspicious because nothing important had truly been solved. Thursday's rescue had bought time, and time can be mistaken for safety when people need safety badly enough. That morning, clients called with a different tone. On Thursday, they had sounded trapped. On Friday, some sounded almost embarrassed by their fear. One man said he'd been ready to sell everything but was glad he'd waited. Another asked whether this might be the bottom. Another, more dangerous still, asked whether the break had created bargains. The broker answered carefully. He could not afford to sound gloomy. He also could not afford, if he had any conscience left, to turn yesterday's terror into today's sales pitch too quickly. He said there had been an extraordinary liquidation. He said support had appeared in leading issues. He said caution was still wise. He said accounts should be strengthened where possible. That last sentence mattered. If clients had cash, now was the time to bring it in. Not because anyone wanted to be gloomy, but because Thursday had revealed how thin many accounts were. Margin that had looked acceptable in a rising market looked fragile after a sharp decline. The broker knew this, and the margin clerks knew it better. All morning they reviewed accounts, called for funds, checked securities, and tried to separate the clients who could survive another shock from those who were merely hoping not to face one. Hope, in that office, had begun to require bookkeeping. Friday trading gave the city reason to breathe, or at least to pretend it was breathing normally. The market did not collapse in the way Thursday morning had threatened. There was buying in some places, support in others, and enough order to make men repeat the phrase that the worst had passed. The phrase moved quickly because it was useful. No one needed to prove it completely before using it. The worst has passed. A man could say it to a client, a wife, a waiter, a doorman, a reporter, a friend at lunch, or himself in the mirror. It had the shape of knowledge and the comfort of prayer. But our broker, if he was honest, would have noticed that relief was not the same as confidence. Relief sits closer to exhaustion. Confidence stands on its own feet. The room was steadier, but not relaxed. Clients watched too intently. Brokers spoke with too much control. Senior men took too many private calls. Every favourable price movement received more attention than it deserved because everyone was hungry for evidence. Every weak quotation was explained quickly because no one wanted it to gather meaning. This is how pretending often works after a fright. It is not always conscious deception. It is selective attention under stress. People choose the facts that allow them to continue. On Friday, there were enough of these facts to build a temporary shelter. The bankers had acted. The market had not failed. Strong names still had buyers. Prominent men were reassuring the public. The country was fundamentally prosperous. Factories had not vanished. Railroads still moved goods. Automobiles were still being purchased. Stores were still open. If one wanted to believe the break had been a violent but temporary correction, one could assemble an argument by sundown and defend it with a straight face. Many did. The broker may have done so too, not because he was stupid, and not because he wished harm on anyone, but because the alternative required looking directly at a larger possibility. What if Thursday had not been the end of panic, but the first public proof that the structure was weaker than advertised? What if the support operation had steadied prices without restoring trust? What if people spent the weekend telling one another the danger had passed, and then arrived Monday to find that the market disagreed? Those questions had nowhere comfortable to sit in a brokerage office trying to keep clients calm, so they were pushed aside. Saturday in 1929 was not a full day of rest for the market. The exchange could still open for a shorter session, and that half day carried more emotional weight than its hours suggested. A Saturday market after a frightening Thursday and a steadier Friday was like a doctor checking a pulse before allowing the family to relax. Men came in wanting confirmation that the patient was improving. The office was busy, but differently from Thursday. There was less open panic and more nervous inspection. Clients who had not sold wanted reassurance that holding had been wise. Clients who had sold wanted proof that they had not made a terrible mistake. Clients with cash wanted to know whether buying now would mark them as courageous or foolish. The broker moved among these questions with increasing fatigue. The crisis had not given him a holiday. It had lengthened every hour. He still had to sound informed. He still had to remember names, positions, prices, promises. He still had to return calls to people who had been told he would call them Friday and had not, because Friday had been crowded with emergencies masquerading as routine work. By Saturday afternoon, when trading ended, the city had something like a weekend to enter, and this created its own illusion. Markets close, but anxiety does not. Still, a closed market can feel like mercy. Prices stop moving. The tape goes quiet. No new quotation can injure an account until the opening bell returns. Families can have dinner without fresh losses arriving between courses. Men can attend church, go to clubs, visit relatives, take walks, read long newspaper columns, and persuade themselves that 2 days without trading is proof of healing. The broker left the office that Saturday carrying work in his head, and perhaps a packet of papers in his hand. He had accounts to think about. He had clients who had promised funds. He had questions about whether certain positions could be carried if weakness returned. Yet for the first time since Thursday morning, he may have had several hours in which no telephone could force him to deliver immediate bad news. That silence was powerful. It allowed denial to recover its strength. Sunday in New York after Black Thursday must have had a peculiar quality. The churches were open, the papers were thick, and the conversation was everywhere. At breakfast tables, in hotel lobbies, outside apartment buildings, at clubs, on trains, and in the private rooms of men with more money than the public would ever see, the same subject returned again and again. Was it over? The question could be asked directly or indirectly. A man might ask what the papers were saying. A woman might ask whether the bank was safe. A businessman might say he thought the market had been overextended anyway. A small investor might say he wished he'd never listened to his cousin. A broker, trapped at a family table, might be treated as both expert and confessor. Everyone wanted his opinion, and his opinion had to be careful because the wrong sentence could frighten people he loved. He might say that the break had been severe but corrective. He might say forced selling had been heavy and probably exhausted. He might say the bankers had demonstrated support. He might say Monday would tell them more. That last sentence was the most honest, and therefore the least comforting. Monday would tell them more. The weekend papers added their own mixture of reassurance and warning. Financial writers, business leaders, bankers, and public officials had strong reasons to project stability. Confidence was not merely a feeling, it was a public necessity. If enough people believed the market had survived the test, perhaps it would. If enough people rushed to sell, perhaps it would not. This made reassurance more than commentary. It became part of the attempted cure. The difficulty was that reassurance can begin to sound like pleading when repeated too often. Readers could feel it even if they did not name it. Strong men do not normally need to say so many times that everything is sound. The broker, reading such statements, might have felt the double pull of them. He wanted to believe. He also understood why they were being printed. When a market depends on confidence, statements of confidence are not neutral. They are tools. Some tools work, some break in the hand. At home, if our broker had children, they may have sensed that something had changed without knowing what. Children are sharp observers of adult weather. They notice when their father reads the paper too long, when their mother speaks more quietly, when a meal has pauses where conversation usually sits. If he was unmarried, perhaps he spent Sunday in a furnished room with newspapers spread across the bed, marking columns in pencil, rehearsing what he would say to clients on Monday. Perhaps he went to a club and found the same strained optimism pouring from every leather chair. Men who had money in the market argued for recovery with the seriousness of theologians defending doctrine. Men who had sold spoke with relief that sounded a little too eager. Men who had lost more than they admitted said very little. In that way, the weekend became a stage for pretending. Not silly pretending, not childish pretending. The adult kind, which is often more disciplined. People pretended so they could function. They pretended so wives would not worry, so clients would not flee, so employees would not panic, so banks would not tighten, so newspapers would not inflame, so Monday might open into steadiness instead of fear. Everyone had a reason. This is why blame becomes complicated when we look at history closely. It is easy to mock the optimism after Black Thursday, but many people believed optimism was part of preventing disaster. They were not only describing the market they hoped existed, they were trying to create it by describing it loudly enough. Our broker understood this instinct because it was his own profession in miniature. Every time he told a frightened client to remain calm, he was not simply reporting conditions, he was attempting to produce calm. If the client remained calm, perhaps forced selling could be avoided. If forced selling was avoided, perhaps prices could steady. If prices steadied, perhaps the advice would become true. In finance, belief can sometimes help make reality. The problem comes when belief is asked to support more than it can bear. By Sunday evening, the city had talked itself into several possible Mondays. In one version, buyers returned, bargains were recognised, and the bad days became an unpleasant memory. In another, the market drifted uncertainly but did not collapse, allowing time for credit, confidence and nerves to repair. In the darkest version, which most people avoided speaking aloud, selling resumed with greater force because Thursday had not removed fear but merely delayed its expression. The broker likely knew all three versions. He may have carried them with him to bed. The house around him was quiet, but the quiet was not peaceful. It was the quiet of a theatre before the curtain rises on a performance everyone has rehearsed differently. Monday, October 28th, began by removing much of the weekend's comfort. It did not do so all at once in the public memory, but in the office it would have felt immediate enough. From the opening, selling pressure was heavy, and the mood that had been carefully repaired over the weekend began to fray. The broker could hear it first in the calls. Clients who had sounded steadier on Friday were uncertain again. Those who'd been reassured by the newspapers now wanted to know why prices were weakening if the worst had passed. Some asked whether the bankers would intervene again. That question carried a childlike hope and a practical desperation. Would the powerful men come back? Would they stand beneath the market again? Would they buy in the leading names and show everyone that Thursday's rescue was not a one-day performance? The broker did not know. He watched for signs. He listened for word from the floor. He looked toward the partners. The room waited for rescue the way a sick room waits for the doctor's footsteps in the hall. But markets can be cruelest when they have taught people to expect rescue. Monday's selling continued. Stocks that had seemed supported weakened again. The Dow, though our broker may not have spoken of it every minute in the way later histories do, was falling hard. Nearly 13% would be lost that day, one of the sharpest declines in American market history. In the office, that percentage arrived as many smaller blows. A quotation shouted across the room, a client's account slipping below requirement, a sell order executed far lower than expected. A clerk pale after checking figures twice, a partner's face settling into a look that told more truth than his words did. The phones became loud again, but Monday's calls were different from Thursday's. Thursday had carried shock, Monday carried betrayal. People had spent the weekend believing, or trying to believe, that the crisis had been contained. Now the market was telling them that their relief had been premature. A client might forgive a sudden panic more easily than a false recovery. The broker heard it in the anger. You said support had come in. You said the bankers were behind the market. You said good stocks should recover. He had said some of those things, or things close enough, because they had been reasonable at the time, or at least necessary. Now those words returned with their edges sharpened. He could not defend them fully. He could only work the account in front of him. Margin calls multiplied. Selling fed more selling. The ticker struggled under the volume. Rumour filled the delay. By afternoon, the office was no longer pretending in the same way. Some men still spoke optimistically because speech can lag behind comprehension, but their bodies had changed. Shoulders lowered, faces tightened. Clark stopped joking entirely. A man who had bought on Friday because he believed Thursday had marked the bottom stood near the quotation board with the expression of someone watching a bridge disappear behind him. The broker did not have time to comfort him. That was one of the small brutalities of the day. There were too many people in distress for distress to receive individual attention. Panic makes private pain crowded. By the close on Monday, the city had crossed a line, though many still did not know how to name it. Thursday could be remembered as a frightening break met by intervention. Friday and Saturday could be framed as stabilization. Sunday could be filled with reassurance, but Monday had damaged the story. It suggested that the market had not been cured by confidence, only sedated for a weekend. Our broker left the office later than usual, if he left at all before evening. The day's losses were not merely numbers to him. They were voices he had heard, orders he had written, promises he had been unable to keep, and calculations waiting on desks for morning. He knew Tuesday would be hard before Tuesday arrived. That is an awful kind of knowledge, the kind that stands at the foot of the bed before you lie down. At home, he may have said less than he had said after Thursday. After Thursday, there had been a rescue to describe. After Monday, there was only the market's refusal to behave according to the weekend script. He might have read the evening papers and found the language already straining to keep up. He might have avoided them entirely. He might have sat in a chair with his collar loosened, listening to the ordinary sounds of the house, and feeling how far they were from the room he would return to in the morning. Somewhere in the city, clients were trying to arrange funds they did not have. Somewhere, bank officers were reviewing loans with new severity. Somewhere, men who had spoken confidently at Sunday dinner were calculating losses in private. The phones were quiet again because night had closed the offices, but no one who had heard them on Monday could mistake that quiet for peace. It was only the interval before they rang again. and by then the market would open into a Tuesday that would make even Thursday's panic seem, to some who survived it, like a warning they had failed to understand. Tuesday did not wait for men to be ready. It did not arrive as a lesson or a symbol or the beginning of something historians would later divide into causes and consequences. It arrived as another market morning, and that made it worse. The broker had no dramatic costume for it, no special preparation that could match what was coming. He put on a shirt, fixed his tie, reached for his hat, and entered the same city he had entered the day before. The streets were familiar. The buildings had not moved. The exchange still stood at 11 Wall Street with its columns facing outward, as though stone could instruct men in discipline. The same clerks hurried through the same doors, the same elevators lifted men to the same offices, the same telephones waited on the same desks. This is one of the hardest things to understand about catastrophe when you have only met it in history books. The room where it happens usually looks much as it did yesterday. A desk remains a desk. A window remains a window. A coat hook still holds a coat. The ordinary objects do not warn you by changing shape. They simply sit there while the meaning of the day changes around them. Our broker arrived with Monday still in his body. He had slept badly, if sleep was the right word for what had happened during the night. He had closed his eyes, yes, but the market had continued to open and close behind them. Prices appeared in the dark. Clients' voices returned. The sound of the telephone became part of his dream, and then followed him into morning. He entered the office and knew, before anyone said much, that the mood had moved beyond strained optimism. Thursday had been shock. Friday had been repair. Saturday had been inspection. Sunday had been talk. Monday had been damage. Tuesday began with the smell of something ending. Not in a dramatic way, not with men shouting in the hall before the bell, but in the small signs a professional learns to read. The senior partner was already there. Several clerks had arrived early and were speaking in shorter sentences. The margin department had account cards laid out in a way that looked almost surgical. Clients were waiting before the opening, not seated comfortably as they had in the strong years, but standing, pacing, holding newspapers, folding and refolding them along the same crease. One man had not removed his hat. Another stared at the quotation board before there were new prices to read, as if the board itself might explain what Monday had done to him. The broker took off his coat and did not bother to settle fully at his desk. He knew he would be moving all day. The first calls came before the market opened, and their tone was different again. On Monday, clients had asked whether the bankers would return. On Tuesday, many no longer asked as if rescue were likely. They asked what could still be saved. A man wanted his account liquidated at once. Another wanted to sell half, then changed his mind and said all of it, then asked whether perhaps he should wait for the opening, then asked what the broker would do if it were his own account. That question had become almost impossible to answer honestly. The broker could say that each situation was different. He could say that decisions depended on margin, income, the quality of the securities, the client's ability to carry the account, the prospects for recovery. All of that was true. It was also too slow for panic. Panic wants one sentence. Sell, hold, send money, get out, buy bargains, do something. The broker had to speak into that demand with a mind that knew there were no clean answers left. He reached for the receiver, gave his name, listened, wrote, signalled, repeated, and felt the room tightening around him before the opening bell had even released the day. When trading began, the selling was not like ordinary selling. Ordinary selling has variety. One man sells because he needs cash. Another sells because he thinks a stock is too high. Another sells because he is switching into a different issue. Buyers appear at levels they consider attractive. Prices move, but they move within a field of disagreement. On Black Tuesday, disagreement thinned. Too many people wanted the same exit at the same time. Sell orders poured toward the exchange in quantities the system could not absorb gracefully. Stocks opened lower. Some dropped with startling speed. Others had no proper bid at levels that would have seemed unthinkable a few weeks earlier. The ticker began reporting what had happened, but almost immediately the market was moving faster than the printed record could keep up. This was not a small inconvenience. It changed the human experience of the day. In the office, men needed information in order to act, but the information arrived late, incomplete, and already stale. The tape printed prices from a market that had moved on. A client heard a quotation and made a decision, but by the time the order reached the floor, that quotation might belong to the past. The broker understood this and hated it. He could not say to every caller, "I do not know," though in the strictest sense that was often the truth. He knew the last reported price. He knew rumours from the floor. He knew the order flow in his own office. He knew the look on the faces around him. He knew the ticker was behind. But he did not know the stable, present fact that clients expected him to know. The machine that had made the market feel visible for years now revealed its limitation at the worst possible moment. It kept talking, but it was no longer speaking fast enough for the world it helped create. Tape gathered on the floor, in baskets, across desks, in pale loops like shed skin. Clerks pulled at it, read it, carried it, shouted from it, then learned that the numbers they shouted had already been overtaken by new losses. The broker stood near the centre of this paper storm and heard the phones become relentless. Not busy, relentless. A busy telephone can suggest prosperity. This was different. These calls carried fear at a speed no wire system could dignify. Lines lit, bells rang, operators connected and reconnected. Clients were cut off and called again. Men demanded confirmations that had not yet arrived. Orders placed earlier in the morning came back executed at prices that produced disbelief. Sell at market had become one of the most frightening instructions in the office because the market was no longer a calm place where a reasonable price waited. It was a crowd of orders pressing downward. A client who said, "Sell at market" meant, in plain terms, take what can be found. But when everyone says that together, the phrase becomes a surrender. The broker tried to slow a few clients down. He could hear in a voice when a man was not making a decision but fleeing his own imagination. Yet he also knew that waiting could be ruinous. This was the moral trap of the day. Sell now and lock in a devastating loss, or hold and risk a forced sale even lower. Meet margin if you can, but many could not. Buy if you are brave, but bravery and foolishness were beginning to wear the same hat. No professional phrase could make that trap kind. Around late morning, the office no longer separated cleanly into employees and customers. Everyone was involved in the same emergency, though not in the same way. A clerk who earned a modest salary could watch a wealthy client become pale and shaken. A junior employee might carry an order that erased more money than he would see in years. A customer who had once enjoyed being recognised by the staff now wished not to be noticed at all. Men who had always treated the office as a club discovered it could become a place of exposure. Loss has a way of undressing people without removing their clothes. The broker saw pride fail in small, specific ways. One client stopped using elaborate financial language and simply asked, "How much is left?" Another sat in a chair with both hands on his knees, not reading the tape anymore, not speaking, just waiting for his name to be called. A third insisted that a certain stock could not fall below a particular price because it never had, and then watched the board prove that the past was not a rule. The broker had no time to comfort them properly. He could offer a sentence, a hand on a shoulder perhaps, a promise to check again, but then the telephone rang. The clerk appeared, the partner called his name, and the room pulled him back into motion. Outside, the crowd thickened. Wall Street had become a public surface for private ruin. Men gathered near the exchange and outside brokerage offices, waiting for rumours, headlines, scraps of news, anything that might turn confusion into sequence. Some had money in the market. Some had relatives with money in the market. Some were workers from nearby offices who came out during a break and did not go back as quickly as they meant to. Some were there because the city had learned that something enormous was happening, and the human body wants to stand near enormous things. They watched doors. They watched faces. They asked messengers what they had heard. They read bulletins as they appeared. They studied men coming out of buildings looking for signs. A man who walked quickly might mean news. A man who looked calm might mean support. A man who looked ruined might confirm the worst. The crowd became part of the market's nervous system, absorbing rumour and sending it back multiplied. Inside, our broker did not need the street to tell him the day was bad. The office told him every few seconds. A senior man who had been composed on Thursday was now openly severe. Clerks stopped waiting for complete explanations and moved on fragments, because fragments were all the day allowed. A partner shouted an instruction, and then immediately lowered his voice, aware that clients were close enough to hear fear in volume. Someone knocked over an ink bottle. No one had time to be angry about it. A messenger boy slipped on a strip of tape near the board and got up with his face flushed, embarrassed by a small accident in the middle of a large one. The detail would stay with the broker for some reason. In later years, if he ever spoke of that day, he might not remember every price, but he might remember the boy slipping, the black streak of ink across a desk, the way one telephone kept ringing after the client on that line had already been ruined because no one had told the operator to stop trying. History preserves the large figures. Memory often preserves the useless details because they were what the eyes could hold, when the mind could not hold the whole. By midday, the ticker was far behind. The delay itself became a fact everyone discussed, then feared. If the tape said a stock had sold at one price an hour or more earlier, where was it now? If the printed record could not keep pace with selling, what did current mean? The broker found himself relying on telephone reports from the floor, shouted updates, partial confirmations, and the uneasy pattern of orders in the office. The world had become too fast for its instruments. This is an important point, because the crash was not only a collapse in prices, it was a collapse in the ability of ordinary participants to feel that they understood what was happening while it happened. Information did not disappear. It jammed. It arrived late. It conflicted. It increased fear because it could not settle fear quickly enough. A client might hear that a stock had been supported, then hear it had broken through support, then hear the first report was old, then hear the sale had not been confirmed, then receive a margin call based on a still different figure. At some point, the mind stops treating facts as a ladder and begins experiencing them as blows. The broker watched this happen. He experienced it himself. He'd spent his career turning market data into advice. On Black Tuesday, the data came like debris. He was still expected to build shelter from it. The great names fell with the rest. This mattered emotionally. It is one thing for obscure speculative issues to collapse. People can tell themselves that foolishness has been punished. It is another thing when widely respected stocks, the names that had formed the respectable core of many portfolios, decline under pressure because owners need cash, lenders need protection, and fear no longer makes fine distinctions. The broker heard clients say, "But it's a good company," and he had no argument with that. It might be a good company. It might have factories, assets, management, sales, a future. But the stock was being sold today, and today was the only time in which the margin account lived. That was the day's repeated lesson. Long-term value could not help a short-term loan that had become due in panic. The market was forcing time to shrink. Investors who had imagined themselves patient discovered that their credit arrangements were not patient with them. That is what made Black Tuesday so brutal for the margin buyer. It did not merely reduce wealth, it removed the privilege of waiting. Our broker made call after call. Some clients could not be reached, which created a different kind of trouble. A man who had gone to his office, a meeting, a train, a hotel, or simply refused to answer could not send money he did not know was required. Telegrams were prepared, messages were left, orders were entered to protect accounts. In a calm market, a missing client was an inconvenience. In this market, absence could decide him. The broker would later think about those unreachable men, the way a doctor might think about patients who did not arrive in time. But in the moment, he had to move on. A woman called about her husband's account. That may have happened more than once. Some wives knew exactly what was at stake. Others knew only that their husbands had been distracted for days and that the telephone had become an object of dread. The broker had to decide how much he could say. Legal authority, account ownership, office practice, and human decency did not always line up neatly. He might say that her husband should contact the firm as soon as possible. He might avoid giving details. He might hear fear in her voice and feel a private shame that the language of finance did not have room for the family standing behind an account number. Stocks were not falling only on Wall Street. They were falling into kitchens, bedrooms, school plans, retirement hopes, and marriages. The market entered homes through men who had promised it would help them. In the office, that truth was present, but rarely spoken. There was too much to do. As the afternoon wore on, the scale of trading became hard to comprehend from within. More than 16 million shares would change hands that day, an astonishing volume for the time. Later, people could print that number and compare it with other days. In the room itself, volume meant overload. It meant paper and delay, unanswered calls, late confirmations, crowded wires, hoarse voices, clerks moving until their legs ached, and brokers realizing that the market had become larger than the office's ability to narrate it. A man can endure bad news better when it arrives in order. Black Tuesday refused order. It gave men losses before explanations, rumours before confirmations, requirements before cash, and prices before belief. The broker's professional face, the one he had trained for years, began to fail in small ways. He may not have shouted, he may not have broken down, he may have continued working with impressive discipline, but his eyes would show the strain. His replies would shorten. His patience with foolish questions would thin, even when the questions were not foolish to the person asking. When a client asked whether the market might recover before the close, the broker could not bring himself to offer the old confidence. He might say, "We will have to see." It was a poor sentence, but it was one of the few honest ones left. The close of trading did not end the day in the way people outside the market imagined. The bell could stop new trading, but it could not instantly complete the work. The ticker was still behind. Confirmations had to be sorted. Final prices had to be known. Accounts had to be marked. Clients had to be notified. The office remained active after the market closed because the disaster still had to be entered into records. That administrative afterlife is one of the coldest parts of financial ruin. First comes the panic, then comes the paperwork proving it happened. The broker looked at the tape still printing after the close and felt the full absurdity of it. The machine was finishing the day late, calmly recording trades that had already changed lives hours earlier. It was as if reality had run ahead and left a clerk behind to copy the damage into a ledger. Men stood around it, waiting for numbers that no longer had the power to help them, only to confirm what they had suffered. Outside, the crowd did not vanish when trading ended. If anything, the closing created another wave of waiting. People wanted the final figures. They wanted to know how bad it had been. They wanted a sentence large enough to contain the day. Newspapers would try to provide one. So would market letters, bankers, officials and men in clubs who needed to sound wiser by evening than they had felt at noon. But in the broker's office, no sentence was large enough yet. There were only accounts. One client wiped out, another badly damaged, another forced to sell, another still solvent but shaken, another unreachable, another furious, another quiet in a way that worried everyone. The broker dealt with these one by one because that was how disaster presented itself at his desk, not as a national event, as names, as balances, as calls, as instructions, as the sudden discovery that the man who had sounded wealthy last month now had less than the clerk carrying his message. Evening settled over Wall Street, and the broker was still there. His collar was wilted, his hands were tired, his throat hurt. Around him, the office looked used up. Paper on the floor, ashtrays full, desks disordered, men sitting where they normally stood. A few spoke in low tones about what had happened, but most did not yet have the strength to turn it into conversation. The senior partner emerged from his office looking older than he had in the morning. No one said that aloud. They all noticed. The broker put on his hat eventually, though leaving felt almost improper, as if the day were not done with him. In a practical sense, it was not. The consequences would open again in the morning, in the accounts and the newspapers and the homes of clients. But a man could not stand forever in the wreckage of Tuesday. He stepped outside and Wall Street met him with faces. Some men were still gathered in the street. Others walked without speaking. The city lights came on, indifferent and useful. Somewhere a newsboy shouted. Somewhere a man laughed too loudly, the way people do when they are not amused but need to prove they are still present. The broker moved through it all with the strange heaviness of someone who has been close to too many other people's fear. Beneath his hat, his mind did not yet have room for history. It had room only for the next tasks, the next calls, the next morning, the clients who would have to be told plainly what the tape had finally confirmed. Black Tuesday had ended in the market, but not in the lives attached to it. The ticker had fallen behind the world, and now the world, carrying its losses in folded newspapers and account ledgers and silent train rides home, would have to catch up. The bell had stopped the trading, but it had not stopped the day. That is the part people outside Wall Street often misunderstood. They imagined the close as an ending, a hard line drawn at the bottom of a terrible page, after which men could put on their coats, walk out, and leave the damage behind them until morning. Inside a brokerage office after Black Tuesday, the closing bell was not an ending. It was the moment the noise changed form. The shouting from the floor faded. The flow of new orders slowed. The most urgent calls began to thin. But now came the accounting, the confirmations, the delayed reports, the sorting out of what had actually happened while the ticker ran behind and rumour filled the gaps. A disaster in finance has to be counted. It has to be written down, matched to names, entered on cards, checked against loans, carried into ledgers, and finally delivered to the people who will live with it. Our broker remained in the office as evening pressed against the windows, and the room around him looked less like a place of opportunity than a workshop after an accident. Paper lay across desks and chairs. Ticker tape had gathered on the floor in pale coils, not decorative now, not lively, not the familiar ribbon of daily business, but a record that had failed to keep pace with the thing it recorded. Ashtrays were full. Coffee had gone cold. Clerks who had been moving since morning now stood with the slightly stunned posture of men who have spent all their strength and are still being asked for accuracy. The senior partner moved from desk to desk, not loudly now. There was no point in sounding commanding after a day like that. Authority had lost some of its theatre. What remained was procedure. Check this account, confirm that sale, send that wire, reach this client first thing in the morning, no, try tonight, mark the margin deficiency, prepare the notice, find out whether those funds arrived, ask the bank again, get the final tape. The broker heard these instructions and followed them because work was easier than thought. Work gave the hand something to do while the mind stood back from the edge. If he stopped fully, even for a minute, the day might arrive all at once. So he kept moving. He reviewed accounts that had belonged, only hours earlier, to men who still imagined themselves investors. Now some of those accounts were empty. Others were worse than empty because borrowed money can leave a man with loss after ownership has already disappeared. That is one of the hardest facts to sit with. A person could lose the stock and still owe money. The thing he had bragged about owning, the thing he had watched rise, the thing that made him feel clever and modern and close to the great machinery of American prosperity, could be sold away at a price so low that it did not fully close the hole beneath it. The broker saw this in figures before many clients saw it in words. He knew which conversations would be terrible. He knew which men would rage, which would plead, which would ask whether there had been a mistake. Some would insist they had never authorised such risk. Some would say they had trusted the firm. Some would point back to advice given months earlier under conditions that now seemed to belong to another country. The broker could already hear the voices. They waited for him in the account cards. There is a particular fatigue that comes from knowing tomorrow's pain before tomorrow begins. By late evening, the building had changed around him. Offices that had been loud all day were dimmer now, though not empty. Men remained where they normally would have gone home. Some sat with jackets off and sleeves rolled, reviewing lists beneath desk lamps. Others stood by windows and looked down at Wall Street without really seeing it. The street below had not cleared in the usual way. People lingered. They gathered near entrances, under lamps, around newspaper boards, outside places where fresh bulletins might appear. The crowd was smaller than during the heat of the day, but its presence after dark made the event feel larger, as if the market had overflowed its hours and become part of the night city. A man leaving a brokerage house could feel eyes move toward him. Did he know something? Was he ruined? Was he important? Was there news? Faces searched faces because official information had been late all day, and people had learned to read one another when the tape could not keep up. Our broker delayed leaving, partly from duty and partly because outside meant facing the city as a man who had been inside the storm. In the office, everyone understood the day without asking him to explain it. On the street, strangers might ask questions. At home, family would ask gentler ones that might be worse. At some point, though, a man has to leave. He put papers in order as much as they could be ordered. He spoke with a clerk about the first calls to make in the morning. He checked one more account, not because checking would improve it, but because he could not quite believe the result the first time. Then he reached for his coat. The movement must have felt ordinary and strange at once. Coat on, hat in hand, desk left behind. This was how every workday ended, and yet nothing in him felt finished. Perhaps he looked back once before stepping out. The ticker machine was still there, silent now or nearly silent, its earlier authority reduced by the knowledge that on the worst day it had not been able to speak quickly enough. The telephones rested too. After hours of ringing, their silence had weight. It was not peace, it was exhaustion. He walked out into the hallway, down the stairs or into an elevator packed with men who did not feel like speaking. The elevator operator, if there was one, may have kept his eyes forward. Service workers in financial buildings often learned more from silence than conversation. They knew when not to talk. In the lobby, the marble and brass still shone. That may have irritated him. The building looked too composed for what had happened inside it. Financial architecture was built to suggest permanence, but that evening permanence felt like a kind of accusation. Outside, Wall Street was cool, and the air would have touched his face with the blunt usefulness of weather. Weather does not care whether the market has fallen. It simply arrives. Men stood in clusters, their hats dark against the lights. Newspapers were everywhere, some already folded under arms, others held open and read under street lamps. Newsboys called headlines in voices trained to cut through traffic and fatigue. The words had the hard shape of public disaster now. It was no longer an internal break, no longer a matter for brokers, bankers, and those who followed the tape. It was news for everyone. The broker began walking, not quickly at first. There is a way men walk after a hard day when the body knows the route but the mind is still at the desk. He passed buildings whose names meant strength in normal times. Banks, trusts, law offices, investment houses, insurance companies, the structures of an economy that had looked so organised from the street. Inside those buildings, men were making lists, estimating exposures, placing calls, deciding what could be carried and what could not. Outside, people looked at the same facades and wondered whether they were as solid as they seemed. That was one of the changes after the crash. The public had been reminded that institutions are not made of stone only. They are made of promises, loans, confidence, timing, and human judgment. Stone can stand while promises fail inside it. Our broker could not have known the full history that would follow. He did not know how long the depression would last. He did not know that bank failures would spread in the years ahead, that unemployment would climb to levels that would alter American politics, that farms and factories and households far from Wall Street would feel consequences still gathering beyond the horizon. He did not know that people would later place 1929 into books as a dividing line, a before and after. That evening he knew only the immediate wreckage. He knew clients who would wake tomorrow poorer than they had admitted they could become. He knew his firm might be strong enough to survive, or might not be, depending on exposures he did not fully see. He knew some colleagues had lost money of their own. He knew that the old easy confidence of the customer's room would not return in the same form, even if prices recovered for a time, even if bargains appeared, even if some men insisted the decline had gone too far. Something had been injured that no rally could quickly repair. The idea that the market was a machine for general advancement had been replaced by the knowledge that it could also become a machine for forcing private ruin into public view. As he walked, he may have passed men who were still talking loudly. Loud talk after a catastrophe can be a form of self-defense. One man might say he had sold early, whether or not it was true. Another might claim he had never trusted the market in the first place. Another might blame speculators, bankers, politicians, the Federal Reserve, newspapers, short sellers, fools, foreigners, or anyone far enough away to be useful. Blame is one of the first shelters people build after loss. It gives shape to anger before grief can settle. The broker had heard plenty of blame already, and more would come. Some of it would be deserved. Much of the market had been reckless. Margin had been too easy. Enthusiasm had been cultivated. Warnings had been brushed aside. Important men had spoken too confidently. Ordinary people had been encouraged, directly or indirectly, to mistake rising prices for proof of wisdom. Yet even knowing this, the broker could not reduce the day to villains. He had seen too many ordinary motives inside it. Desire to improve, fear of being left behind, trust in respectable voices, pride after a few successes, hope for a child, a home, retirement, a business expansion, a gentler life. The crash did not punish greed alone. It reached into many kinds of hope, including some that were not shameful at all. That is part of why it hurt so deeply. If only the foolish suffered, the story would be simple. But history rarely offers that convenience. Somewhere along his walk, perhaps near a subway entrance or a ferry terminal, the broker slowed. Men were reading the late editions with the hunched concentration of people trying to learn what had happened to them. Some had no investments but understood that Wall Street's trouble might not remain on Wall Street. Others had accounts they had not yet dared to check. A man might read a headline and then look up, not at anything specific, just up, as if the city itself owed him an explanation. The broker recognized that expression. He had seen it all day indoors. Now it was on the street. The market had escaped the office completely. At home, if home was where he went, the door opened onto a different kind of silence. The family room, the apartment, the boarding house, the hallway with its familiar smell of cooking or dust or radiator heat. All of it belonged to a life that expected him to re-enter as himself. That was difficult. A man who has spent the day as a broker cannot easily become only a husband, father, son, or lodger at night. The office clings. If his wife was there, she may have asked how bad it was. Not how was your day? By then everyone knew not to ask it that way. How bad was it? He might have removed his hat before answering. He might have said very bad, because pretending had finally become too heavy. He might have said they would know more tomorrow. That sentence again. Tomorrow had become the place where every unfinished fear was stored. She may have asked whether they were all right. That question would have been harder. All right financially? All right in his work? All right in the country? All right in the deeper sense no husband could promise after a day like that. He may have said yes if he could, or I think so, or we will have to be careful. The words available at home were smaller than the event. He sat down, perhaps, and for the first time all day felt how tired he was. His collar came off, his shoes hurt, his hand may have ached from writing, his ear still carried the pressure of the telephone receiver. In the quiet of the room, individual voices from the day returned more clearly than they had in the office. The man asking how much was left, the woman trying to reach her husband, the client who could not understand how a good company could fall so fast, the clerk repeating a price and then correcting it lower, the partner saying to sell because the margin could not be met. These were not abstractions, they were the human residue of the market. He might have eaten little. Many men in such circumstances do. The body asks for rest more than food. If children were present, he may have tried to behave normally for them, asking about school, touching a head, smiling at the right time. Children do not need full explanations to know when adults are acting. They hear the effort. Later, when they were sent to bed, the adults could speak more plainly or not speak at all. Silence between two worried people can be a conversation if both know its subject. Across the city and beyond it, similar rooms were holding similar silences. Some households had lost savings. Some had lost paper gains they should never have counted as secure. Some had not lost directly, but had begun to fear for jobs, loans, customers, banks, businesses and relatives. The crash was still mostly financial on that Tuesday night, but it had already begun the slower work of becoming social. Loss moves outward. First the account, then the household, then the firm, then the bank, then the employer, then the town, then the nation. Not all at once. Not with the clean timing of a bell, but outward. The broker did not need to see the whole pattern to feel the first ring of it. In the days that followed, stories would circulate, some true, some exaggerated, some repeated, because people needed images large enough to match their fear. There would be stories of men ruined, men collapsing, men disappearing, men taking desperate actions. The famous image of ruined brokers leaping from windows would become part of the mythology of 1929, stronger in memory than in the documented reality of those first days. That distinction matters. We should not turn suffering into theatre just because history has handed us a dramatic picture. Yet the fact that such stories spread tells us something real. People believed them because the emotional truth of the week made them plausible. The market had not merely moved down, it had humiliated an entire culture of certainty. It had shown that a man could enter an office in the morning dressed as success, and leave in the evening unsure what that suit still meant. Our broker would return to work after Black Tuesday, because offices do not vanish when dreams do. There would still be trades, notices, calls, clients, settlements, arguments, and attempts to rebuild. Some stocks would recover part of their losses for a time. Some men would claim the worst was over again. Human beings are very good at trying to restart the story that comforted them before, but he would not hear the phones in quite the same way. He would not look at a margin account in quite the same way. He would not mistake a crowded customer's room for proof of wisdom in quite the same way. The man beneath the hat had been educated by a day no school could have designed. He had learned that confidence can be a useful tool, a professional mask, a public duty, and a dangerous drug. He had learned that information arriving late can be almost as frightening as no information at all. He had learned that people do not become numbers just because the account card uses numbers to describe them. And he had learned that after the bell, when the shouting stops and the tape finally catches up, the market continues in the quiet walk home, in the dinner not eaten, in the wife's question, in the unopened envelope, in the client who will call again tomorrow because loss, once recorded, still has to be lived. So when we look back now at the Wall Street crash of 1929, it is useful to remember the charts, but not only the charts. Remember the broker's desk, the ink, the receivers, the account cards, the clerks moving through paper, the men in hats waiting outside the exchange, the woman calling for her husband, the ticker printing too late, the office after dark, and one tired man stepping into the street with no clear way to explain what had just passed through his hands. He walked home from Wall Street that night through a city still lit, still moving, still trying to look like itself. Behind him, the exchange was closed. Ahead of him, the consequences were only beginning to open.